All right. Hello, everybody. Today is going to be a long day. It's going to be an exciting day. And it's going to be one of those days that I think are, well, at least defining for the next couple months in terms of what we've got going on in the markets. We've got Google, Microsoft, and AMD reporting today. Super excited to see what they end up doing. I have a big position in Google, at least big for me. So that's the one that I've really got my eyes on. But Microsoft, I think, is the important thing for those that care about Palantir, for those that care about really any AI related names. AMD, I think, is going to do fine, primarily because the market has given it a bit of momentum because they know that the GPU demand from NVIDIA is strong. SMCI reported earnings yesterday, absolutely phenomenal. So CPU demand in the context of AMD should be fine. I don't think they're going to have bad numbers like Intel did and reduce guidance and things like that. But I do think that Microsoft numbers are going to be incredibly interesting because we're expecting 15% year-over-year growth, highest in 2 years. Valuation is up 33% in the past 3 months. AMD is basically doubled. So I think the paradox all of us are having is that we know these companies are incredibly important. We know they're valuable. We know AI is real. But how real is it to justify the run-up that we've seen in these valuations? And make no mistake about it, if these companies cannot perform, it's going to be tough. It's going to be really tough to keep these numbers the way they are. S&P at QQQs at all-time highs. If these numbers don't come in the way they need to come in, it's just going to be hard. So that is why today is so important. And that's why if you're an investor in any equity, in my opinion, much less, some of the big tech names, this one's a big one to see what happens. Hello, everyone. Thank you for being here. Philip Rizzo, Freddie, Suri, Felicia, Mr. Seymour Duck, Dale, To Allen, Doug, Hans, John, Mike, Shoes, Shantoshi. Is that your name? Shantosh? I'm sorry if I'm saying it wrong. You are right on SoFi. Well, we got about 10 minutes till the market closes. So we'll talk about some general stocks and then we'll get into big tech earnings, which as soon as the bell rings, we're going to have to get into that. SoFi tanked the bet today. So SoFi 841 down 8.24%. It was up at the peak yesterday. It was up about 30%. And it closed off 20%. Now it's down 8%. So overall, net post earnings, SoFi is up 4% this week, which is just, it's, yeah. This is why you got to get out of these options sometimes, dude. I mean, my options would have been, I would have made like $300 if I didn't sell yesterday. I made $1,200, which is a little bit more than $300. So it is what it is, dude. It's so hard to time these things. Sometimes you get it right. Sometimes you get it wrong, especially with options. So you just got to take what you can get. But SoFi had a crappy day. And it's not just a crappy day for the market. I mean, the S&P right now is at 491. The S&P is green. So you can't really blame the SoFi decline on the market. The SoFi, even Tesla is freaking green right now. Tesla's at 192. And TFC, you guys know I got a big position. I mean, TFC is breaking out 38.28. It hit 38.47 at one point. The reason SoFi is down is because the street doesn't like this stock. That's the problem. And I don't know what it's going to take for the street to like them. They're gap profitable, guidance. I just don't know, but the street doesn't like it. And yesterday I was wondering, I don't know if the shorts covered or there was just a crap ton of volume from retail buyers. It might have been the latter, because if you were a sophisticated short, you probably knew that this was going to happen and you probably didn't cover because you knew it was going to fall again. So we'll see. Maybe it rebounds back to 9, but tough tape for SoFi in the context of it coming down. Lewis says, hello, Amit from Portugal. Thank you for being here, Lewis from Portugal. With whom have you learned options and how long did it take you to understand and feel confident to make your first trade? So everyone knows Chris Patel, one of my friends on the Finance Junkies. He is my mentor when it comes to a lot of this stuff. He has a Patreon that is open. I would highly recommend joining his Patreon. I think it's like $10-20 a month. Let me see if I can link it here. So he doesn't literally do one-on-one consulting on options and stuff like that, but being part of that community in his Discord, you'll get access to a lot of people that can help you do that. And so that I would just join his Patreon. If you go to Finance Junkies on YouTube and click any of our videos, his Patreon is there, and you can check it out. In terms of how long it took to understand it, I think it took a good at least 3 to 4 months to just try to understand it, and then play with some small money, and then make a big trade. My first big trade was TFC. So I think that day I put in $5-10 grand. That was big for me. And so it took a couple months, but it's just not as complicated as I think people say. It's actually a fun game once you understand it. If you like numbers and if you like making money, that's a really good motivation to get into it. But it's not as complicated as what people think. I hate when people are like, oh, only stick to buying stocks. Don't do options. It's too risky. It's dude, why are you stopping someone? That's like saying don't get into computer programming. Like, computer programming is hard, but would you stop someone to try to learn it? It's like, no, just like, that's such a loser mentality. Be calculated, take very small risks, play with paper money, learn it, and then do a couple small trades and see what it looks like. That's it. It doesn't have to be that complicated at the end of the day, but you do have to have the appetite to deal with the volatility of it. So yeah, that's what I would recommend doing. SoFi shorts covered and reshorted. That could be one thing that happened. That could be one thing that happened as well. PayPal layoffs. That's another thing. PayPal layoffs. So we got some news on that. PayPal laid off 2,500 employees. Stock was at 64. It's green on the day, like 0.05% or whatever. Why did PayPal lay off employees? Well, Alex Chriss, the CEO of PayPal, the new CEO of PayPal, he said they were going to right size the ship on his Shock the World announcement. And that right sizing of the ship ended up being a shock to 2,500 PayPal employees. So the information reported PayPal began company-wide layoffs on Tuesday, the latest tech company to cut jobs, as newly appointed CEO looks to cut costs and improve profits. Various employees on LinkedIn also commented that they've gotten laid off. So, I mean, it is what it is. It's a tough thing to happen. Obviously, you feel horrible for the 2,500 people, but the street needs to see cost reduction. PayPal as a company could not survive unless, they get shareholders to be more excited about the stock. And to get shareholders to be excited about the stock, you have to reduce some of your expenses. If you're not increasing your growth, that is the hard reality of capitalism. And as you get older, you start to recognize just the cutthroat nature of what it means to run a business and run a company. And that's the decision PayPal made today. Now, they cut 7% of employees, about 2,000 last year around this exact same time, February 2023. So overall, about 4,500 employees have been let go by PayPal. And I would imagine their operating expenses start to come down a little bit in the coming months because of this, after they pay severance and everything else that they have to do there. And so I think that'll be super important for PayPal, and we'll see what happens in regards to the actual stock on PayPal as well. Now, speaking of layoffs, we got 5 minutes till the market closes, guys. Today's going to be a really big market close. I'll be here till 6, so I'll be here for the next 2 hours. So get comfortable, get some food. I got my 0-calorie Gatorade here, ready to go. I'm trying to stop the energy drinks, so we're going to use 0-calorie Gatorade. And we got Google, AMD, Microsoft, and then we got Google Call. We're going to be streaming Google Call at 5 p.m., but we'll have a good hour to dissect and see everything that's going on. So here are the layoffs that's going on, okay? Here are the layoffs that are going on. It's a lot, okay? Pixar, 1,300 employees. Unity, 1,800. Wayfair, 1,650. UPS, 12,000 this morning. Citigroup, 20,000. That was last week. Salesforce, 700. American Airlines, 650. Twitch, 500. Spotify, 17%. Duolingo, 10%. eBay, 9%. Washington Post, 10%. Business Insider, 8%. Business Insider, that was a couple days ago. They announced that. The Business Insider is trying to become more like the Wall Street Journal, so they're getting rid of all the tabloid stuff. Good luck with that. I don't know if they're going to be able to figure that out, but they get laid off a bunch of people. Google, 1,000 employees. Meta, 60 employees at Instagram. Discord, 170 employees. That was that girl that went by the way, remember that girl that went viral? That video I showed you guys like 2 weeks ago of her losing her job, and she recorded her live reaction. That video got like 30 million views, and now she's starting a podcast. Like, she took the attention from getting laid off, and now she's getting these brand deals, and it's crazy, dude. That just speaks to how amazing social media is. You can take a crazy situation like getting laid off, have a fun reaction to it, which most people thought it was fun, right? The way she reacted, and then start a whole content career. Now, granted, it's not easy to do content. You guys know it's not easy to do content. It's incredibly difficult. So you have to really put yourself out there and try. And I would say it's harder than just living a 9-to-5 because there's no certainty. You got to be creative and all this stuff. But maybe that's the route this girl goes now. And I think a lot of people will go that route. There was a stat I saw today. I'm going to try to pull it up, but 3.4 million people apparently in Q4 quit their jobs. Let me see if I can get this stat. And that was incredible to me. And that kind of showed why the JOLTS report came in hotter than expected. That's also something that got the market a little, I don't know if that's the reason the SoFi fell, because the broader market's fine. But 3.4 million people apparently quit their jobs last quarter, which led to a lot more job openings. Obviously, we had 9.02 million versus 8.7 million. Yeah, 3.4 million quit their job. So here it is. 3.4 million quit their job. That's fewer than immediately before the pandemic. Quits are now consistent with a conventionally strong labor market. A lot of people are realizing, that they have opportunities outside of just going the traditional job path, which is not the best for inflation because that means there's less competition for wages, more wage inflation. But I overall think the JOLTS report was a nothing burger. We didn't even see the markets really crash on it. We saw a slight decline and then it was recovered. So some individual equities didn't do the best, but overall, the JOLTS report was not something to be concerned about. Now, unemployment going higher, given all the layoffs I talked about 2 minutes ago, that might be something that we should be concerned about. But I think in the next probably 2 or 3 weeks, we get jobs reports. We'll know. FOMC, I'll be live streaming it tomorrow as well. That's going to be about 2:30 p.m. I'll be live like 2:20, 2:25. Jay Powell will be talking, and we will be analyzing what he has to say and if he thinks a March cut is likely, which I think he's going to say no, but there's a part of the market that kind of thinks he's going to say yes. So tomorrow is going to be a very important day as well. Aztec says, why SoFi keep falling after good news? Your guess is as good as mine. Your guess. I just think the street doesn't want SoFi to succeed because they're this little bank that's fast growing and they might take away market share from the other banks, even though I feel like that's a nebulous reason because JP Morgan doesn't give a shit about SoFi and BlackRock. Like, but maybe they're kind of just like, we don't want to, I don't know. It's a bank and banks typically don't get high multiples, but it's a fast growing now profitable bank that is getting 50% of its revenue from non-lending services. So to me, there's just no reason for it to be down. And a lot of big FinTwit accounts on Twitter, they got very excited about SoFi yesterday. A ton of these accounts with hundreds of thousands of followers saw those earnings and they were like, what the hell? How is this stock at $8? So a lot of, many accounts of this stock should be worth double, which theoretically it could, but the street doesn't like it. The street doesn't like it yet. Chamath effect, that's why it's down. Damn, that's mean. That's mean. That's wild, dude. That's wild. Jobs report is not Friday. I think the ADP private payrolls are on Friday. You're correct. I think that is. The JOLTS report was today. Private payrolls should be on Friday. All right, folks. We've got a bell that's happening in how many seconds? In literally 15 seconds. As soon as I ring the bell, I'm not going to go to all the stocks. I'm going to go to I'll leave Google up, and then I'm going to go to Google's website and try to find these numbers. Here we go. January 30th. We're here for the next couple of hours. It's 4 p.m. The stock market is now closed. All right, here we go. Stock market's closed. We got 3 main stocks that we're tracking. Google is the first one. I'm going to all the numbers I need to get to, going to all the websites I need to get to, and then I think within 5 minutes, usually we get to these numbers. Microsoft's the big one, but Google I want to do first because your boy has some money in Google. We got to see what happens. But Microsoft's another big one. Microsoft, I think, is the most important one because of Microsoft's valuation is the biggest. And that valuation is going to determine a lot about AI spend throughout the broader economy. Okay, so what is Google at right now? What do we got? Google is it's down almost 1% after hours. I'm looking at investor updates. We're going to go Google, Microsoft, AMD. Okay, we'll leave AMD for the last. We'll go Google, Microsoft, AMD. We're going to run through their press release, get a high-level overview, see all the numbers, then go back and go nitty-gritty into the financials and see what we can get. So far, nothing on Google. Put in the chat, by the way, do you own any of the 3? Google, Microsoft, or Amazon? Or AMD? Which ones do you own? Which ones do you own? And, if you want to say how many you own, that would be cool as well. How many do you own of it? By the way, that Wedbush guy, he still reiterated his price target on SoFi at $3. I don't know if that's the reason the stock is down, but he thinks it's worth $3. Okay, Google's not out yet. Microsoft IR, Microsoft is not out yet, and AMD is not out yet. So we're still waiting on those 3. Jujuki says Google and Amazon. Nick says Microsoft. Han says I own all of these. Tesla. AMD 3K shares, Microsoft calls. Did anyone do any earnings plays as well? Juki says Google, Amazon, Jules, Microsoft, or AMD. I own AMD and Google. Okay, Google right now is, it's basically flat after hours. Nothing too crazy yet. So the numbers are still not out. Yeah, is anyone doing any earnings options on these guys as well? Or did you YOLO and buy any of the stocks before it happened? I didn't touch any of these, dude. I'm so afraid of these valuations. And, maybe I'll be wrong about that, but I did not touch any. I didn't touch my Google position. I posted it on Twitter, so you guys can check out my Twitter real quick if you want to see the Google position. Microsoft beat. Okay, Microsoft's out. Microsoft is out. Let me pull that up. So that one came out before Google. So by the way, if anyone gets a link, please put it in the chat because some of these Some of these are, oh, Google's down. Oh shit, Google's down. Google's down 3% already. Okay, so maybe Google didn't do the best. Okay. Yeah, here we go. Microsoft. Is this it? Is this it? Microsoft latest. Yeah, here we go. Microsoft beat. Okay, so here's the basic numbers. We'll get into the deep nitty gritty for a second, but here's the basic numbers. Microsoft EPS of 293 beating 2.77, revenue of 62 billion versus 61. So they beat revenue by 900 million. They beat EPS by about 20 cents. Where's the stock? That's not too bad. Where's the stock? The stock is down about 1%. Okay, that's nothing crazy. It's basically flat. It's basically flat. Okay, so now where's Google? Let's do Google. Where's Google? Oh, here it is. Here's Google. All right, here we go. Google, ad revenue 65.52 versus 65.8. That's down. Fourth quarter revenue. Oh, they beat on cloud. Thank God they beat on cloud. Thank the Lord they beat on cloud. Oh my goodness. They beat on cloud. Operating income 23.7 billion. Okay, so they beat on cloud. Where's the actual okay, here we go. Here we go. So fourth quarter revenue 86.3. Oh, they beat by about $1 billion on fourth quarter revenue. EPS they beat by 5 cents. Cloud they beat. Services they beat by $1 billion. Other bets revenue, that's like their venture stuff. That's fine. Okay, cool. So their numbers should be up on their website. Okay, here it is. So here's the Google website. Here it is. Google beat on cloud. Why is Google down? Microsoft's down 1.34%. Google is down 5 fucking percent, dude. What the fuck? Why is it down 5%? Oh my God. What numbers are the street looking at? What are they looking at, dude? What the fuck? This is not this. All right, so let's read. Sundar Pichai said, we are pleased with the ongoing strength in search and the growing contribution from YouTube and cloud. Each of these is already benefiting from AI or whatever. CFO said, we ended 2023 with very strong fourth quarter financial results with Q4 consolidated revenues of 86 billion, up 13% year over year. We remain committed to our work to durably re-engineer our cost bases. Okay, whatever. Okay, so search was 48. Oh, wow, that's not bad. They did 6 billion more year over year. So looking at their balance sheet right now, 6 billion more. YouTube ads, wow. YouTube did 9.2 billion. That's the first time they've done 9 billion on YouTube ads. That's the first time. Google did not miss, guys. I don't know why the stock's down, but Google did not miss. That's the first $9 billion quarter. They've always done 8.3 to 8.5. They've kind of come in with Netflix because they operate a lot like Netflix in terms of quarterly revenue. That's a big, big number on YouTube. That's incredible. Google Network did 8.2 billion, advertising 65 billion. That's up 6 billion year over year. Cloud did 9.1 billion versus 7.3 billion. Last quarter, I think they did 8.4 billion. So they beat that by like 600 million quarter over quarter, which is not bad. Traffic acquisition cost, that's what TAC is up 13.9 billion. That's relatively, that's up a little bit. Number of employees, they cut 8,000 people since last year. 8,000 people Google cut. Wow. Okay, we'll get back to Google. Let's go to Microsoft real quick. We'll get back to Google. Let's go to Microsoft. Here we go. Here's Microsoft's. Here we go. Here's Microsoft. Okay. So revenue was 62 billion and increased 18%. That's a good number. That's phenomenal on Microsoft. Google's down about 3.6%, recovering a little bit. Microsoft is down barely 1%. Microsoft's not really moving that much, which I mean, the street expected 15% year over year growth. Microsoft brought in 18. That's not bad, dude. That's not bad. Operating income was 27 billion. That's up a third year over year, 33%. Net income is up 33%. That's incredible. They brought in 21 billion in profit. I'm going to look at Google's profit in a second. I think it's the same, kind of 1/3 of the revenues. Diluted earnings per share was 293, an increase of 33%. Okay, and they beat on EPS. So let's look at the individual businesses. Cloud, 25 billion they did in cloud. Holy crap, that's a lot. So productivity in business was 19.2 billion. This is like Office and PowerPoint and all that stuff. LinkedIn revenue's up 9%. So people are buying more LinkedIn ads. That's great for Microsoft. They acquired them for like 22 billion back in 2016. So that was a while ago. Dynamic products and cloud revenue increased 21%. Okay, in terms of gaming, Windows revenue's up 9%. Personal computing, 16.9 billion. That's up 20%. Xbox is up 61%. And that's primarily driven by Activision acquisition. So that's gaming. Devices revenue decreased 9%. That's okay. That's like their laptop, Surface Pros, all that stuff. Search and news advertising revenue, excluding TAC, which is your traffic acquisition cost, increased up 8%. It's a beat all across the board. It's not bad. 8.4 billion. Wow, they bought $8.4 billion worth of shares. They bought back their stock. I'm looking at Google to see if they did any buybacks. I can't find anything yet. Share repurchase. I'm trying to command F those words. Oh yes, here we go. I think we got it. 2023 repurchases of stock. Overall, 2023. I don't know if we have. It looks like they're saying they bought back 61 billion over the course of the year, which means if you just divide that by 4, that's close to 15 billion. If I'm not wrong, I could be wrong on that, but it looks like Google's saying they bought $15 billion worth of stock, which is not bad. That's not bad either. We're going to have to get an update on that number, but that's not bad. This is not too bad. These are not horrible. AMD is red, but no news. Okay, we'll get to AMD in a second. So let's look at the stocks. Microsoft's down 1%. That's not a big deal. Google's down 4%. I don't know why they're tanking Google, dude. I really don't. I'm trying to find the reason why. Like that might be a short-term reaction that goes away after the call, but YouTube's at a record number of revenue, $9 billion. They've never done that before. Search is up 48 billion. Dude, last quarter they did 44 billion. They increased it by $4 billion. That's not easy to do. That's a great. And then cloud is up almost 600 million from last quarter. Month end sell off. I mean, yeah, that's fair. And I think all of us expected a little bit of February is the worst month for tech stocks, so I think all of us expect a little bit of decline. Let's look at the S&P. But 5% seems a little aggressive, dude. A little aggressive. S&P is down about 0.2. QQQ is down about 0.3. Where's Meta because of this? Is Meta down because of this? Yep, Meta's down about 1%. Nvidia down. Nvidia's down about 1% as well. And then where's AMD? AMD is down 1.29%. Okay, let me pull up AMD's numbers, and then we'll go deeper into the financials. Is AMD out? Why is AMD not out? Is AMD not out? AMD? Yeah, they're not out. Did they forget that they had earnings? Okay, let's do Starbucks since AMD is not out. Where's Starbucks right now? Starbucks is green. So coffee's green. At least we got some coffee. That's green. Starbucks. Let's pull up their numbers real quick. Let's do high level overview on these guys. Q4 fiscal results, more earnings release. Okay, here we go. Here's Starbucks. Starbucks. At least Starbucks. Starbuccaneers, you have your day. Starbucks is up. Okay, so revenues are up 11%, $9.4 billion worth of global coffee. Sales up 8%, up 8% in North America, 5% international. EPS of $1.06. 20,000 stores. They beat more than 20,000 stores international. Global count is 38,000 across the world. 32 million memberships, up 14% year over year. Those are like that's like the Starbucks app on your phone or something to get rewards. I don't even know if I have one of those. I think I do, but damn, dude, almost 33 million people use that little mobile app to get rewards on their Starbucks. Wow. Okay. Well, I mean, high level overview, Starbucks did great. I mean, that's not 11% year over year is not easy for a company like Starbucks, especially with all the logistical infrastructure they have. That's incredible. That's absolutely. And then memberships up 14% year over year. That's great. Starbucks is up. Google is down. Starbucks is up. Google is down. They beat on the store. Beat on the store count. Thank my wife. Yeah, dude. I would imagine. I'm going to pull up CNBC as well. Let's see what these guys have to say about what's going on. But so far, I think we're getting an unnecessary sell-off on Google. That doesn't seem like it's reasonable right now for Google. Let's see what CNBC is saying about these earnings.
Overtime today, Adam Crisafulli. Alphabet is another one, and I believe Alphabet right now is still down about 4.5% roughly. Looking at these numbers, I notice it's really Google Cloud that came in a little better than expected, but that core business, Google advertising, search and other, and YouTube ads, both of those just in line are actually a little bit under the consensus expectation. I wonder how much that has to do with it.
Yeah, that definitely, I think, the knee-jerk reaction. I think for a lot of these names, if there's anything wrong, especially in the initial, reaction after the first few minutes after the press release, I think the reaction will be to sell the stock in this type of environment when the names have rallied so much. The core money makers for that company, especially, are YouTube and the core search business. And so, to the extent they're falling a little bit short of expectations, I think that just gives people an excuse to book profits. At least so far in Microsoft, now we have to get the guidance, really nothing to complain about. And even on Alphabet, it's hard to really say that, there's really anything horribly wrong with the numbers. I think it's kind of just, again, a knee-jerk reaction lower in some of these stocks after a big run. But, I think the calls will be very important for a final verdict.
Yeah. And of course, shares of Alphabet are down 4% right now. Microsoft basically at the flat line, EA lower, but Starbucks is actually trading up 2% higher despite that big miss on international comps. Well, Skyworks earnings are out as well, and Kate Rooney has those numbers.
Hey, Morgan. Yeah, so Skyworks here looks like earnings was a 2-cent beat.
Yeah, I think the market's being stupid about Google, dude. I think the market's being dumb. I think this is dumb. Microsoft's coming back. I think they're going to come back. This is it's already recovering a little bit. It's Google's now down 3.7%. Where is Microsoft? Microsoft's green. There you go. Microsoft's green. It absolutely deserves to be green. Where's AMD? Okay, AMD should be out now. AMD should be out. AMD should be out. You know what's crazy? Twitter has been way better at finding the earnings than the actual company's web pages, which is wild, dude. That's wild. Is it AMD not out yet? That's crazy. AMD's not out. This is ridiculous. AMD is not out. What is Starbucks going to do with the China stores? As long as Xi Jinping doesn't get the wrong caramel latte, then I think they'll be fine. But AMD, how do they not release results yet, dude? What is going on? What is going on with AMD? Yeah, it's not out. I don't know if anyone sees it, but it's not out for me. It's not out. Yeah, it's still not out. Still not out. AMD scared because the run up. Oh, 415. Okay, so it should be out in a second. It should be out in a second. Lisa's too embarrassed. No, dude, I think AMD is going to do well. But I do think her stock's up double, and she's like, oh shit. It's one of those things where it's like the market's giving you a lot of love, and it's like you're not allowed to say anything because it's quiet period, but the numbers could mean that you got too much love if the market doesn't like them. The market has sold off regardless of results as they're waiting on the Fed. I agree. I just think a 5% drawdown is a little ridiculous. Microsoft's now up 1%. Google is still down 3.7%. I can understand down 1 or 2%, but these numbers are not worth being bad. AMD's red. Is AMD red? Here we go. AMD. Woo, baby. AMD is red. AMD is ready to be red, if you get what I mean. AMD is red. Red. All right, so let's get the numbers. Let's get the numbers on that. Someone said, rip my AMD calls. Man, I hope you have a little bit more expiration on those than tomorrow, because that's tough. And see, that could have happened on SoFi yesterday. That's why, it's always very scary to play earnings. SoFi could have tanked the bed. Okay, here's AMD. These numbers don't look that bad. Hold on. These numbers don't look that bad. Is it that bad? Is it that bad? Revenue beat slightly, but it beat 6.2 versus 6.13. Operating margin is down 0.2. Street's not going to like that. R&D expenses is in line. CapEx is 19 million more than what they thought. AMD is recovering a little bit. AMD is recovering. Maybe your calls aren't destroyed today. they're down 2%. They're not down 5% anymore. Let me go to the actual website, see what they got. These aren't horrible numbers. They're not amazing, but they're definitely not horrible. All right, so here are the numbers for AMD. 6.2 billion, gross margin of 47%, net income of 667 million. To give you some context, guys, Nvidia does net income of about $6.8 billion a quarter. This is why people like Nvidia over AMD, because Nvidia is, barely trying to get up to, $1 billion a quarter in revenue in net income. So it's like Nvidia is the grant, it's the guy here. For the full year 2023, the company reported revenue of 22.7 billion, gross margin of 46%. AMD, to my understanding, also is a hardware business more than it is a software business. So these margins, that's why these gross margins aren't 70 to 80%, they're 46%. but still not horrible margins at all. Net income for the year was $4.3 billion. Net income for the quarter was $677 million. Lisa Su says, we finished 2023 strong with sequential year-over-year revenue and earnings growth driven by record quarterly AMD Instinct GPU and CPU sales and higher AMD Ryzen processor sales. Demand for our high-performance data center product portfolio continues to accelerate. Positioning goes well to deliver strong annual growth in what is an incredibly exciting time as AI reshapes virtually every part of the compounding market. AMD right now is red about 1%, but it's recovering. It's recovering. I mean, a lot of these guys are recovering, except Google, that continues to just fall into the pit of despair for some reason. So if you got those AMD calls, I mean, it really depends on how the market wants to interpret it. But semis are down. Let's go to the semis playlist I have. So not horrible numbers. We'll get deeper into them in a second. But the playlist, the semis numbers on the overall numbers on NVIDIA are not bad. Let's see how the semis are reacting. So Marvell's down, ARM is down, Lam Research is down, Taiwan Semi is down, Qualcomm is barely up, Broadcom is down, ASML is down, Intel is still down again after falling 12%. SMCI is at 510, it was at 550 today. NVIDIA is down about 0.2%, and then AMD is about 2%. Well, you know, the numbers aren't bad on AMD, so this 2% decline, quite frankly, is because they didn't kick it out of the park. Like, that's what would have got them higher. But again, if we just look at the stock, I mean, over the past 6 months, this is the stock. It was at $93 in October. It's at 180. It's doubled. I mean, it's at 170, right? It's a little bit less than doubling. But like, I mean, you kind of, in the past 4 months for you to double, you got to, you know, just absolutely smash like NVIDIA numbers for you to keep going higher. So to me, that's why we're seeing a little bit of a decline. And I don't know if anyone expected a smash on earnings, but if you got what you got, which is the numbers we looked at, it's definitely not a reason to, in my opinion, you know, tank the stock, but it's also not a reason to take the stock to up 10%. So that's down right now. Oh yeah, we'll add Micron to the semi list. We'll add that now. Are you interested in AMD or chips in general since your new podcast show? Yeah, I mean, by the way, someone DM'd me on Twitter today. They said we should name it from the Semis Pod, which is the BS name we had, to Chip Chat. I like that. Chip Chat. That's a good name. But the reason I'm getting interested in it, not really because I want to invest, but rather just to get a better understanding of how these companies are in, you know, how these companies play a role in the broader ecosystem that we're seeing. Because I think if you're going to be an investor in general, you have to understand how the semiconductors are playing a role, especially if you want to understand AI. Google's still down 4%. Google is still down 4%. My calls are not going to be printing tomorrow. I'll show you guys my position in a second. Microsoft is green, is up 0.11%. Microsoft is green. Do you own AMD? No, don't own AMD. We got jobs report later in the week and Fed tomorrow, FOMC tomorrow. That's the big thing. So this is the Google position I have right now. And this will show you what I was hoping for. I was hoping we inch up to 160, man. And we've got a lot of time for this to happen until 2026. But my calls were up a little bit more than this day. They were up almost $2,500. So it's a 175, 225 spread expiring 2026. The bet is Google gets closer to that, 190, 200 range by 2026, which I think can happen. But this is going to be dead money tomorrow. This is going to be dead money. The stock, this is absolutely, unless the stock recovers, it's going back down. It's going back down. It gives me more time to DCA into this, which I actually wanted to over the past couple months, but I never got to. But it's weird. They're tanking them like they missed expectations they missed on cloud or the search business, and that didn't happen. AMD guidance was bad. Where's their guidance? That's the one thing I forgot to see. Where's their guidance? Where is their guidance? Data center revenue, by the way, was up 2.3 billion in the quarter, which is incredible. And now NVIDIA had like 10 billion or something like that. Where is their guidance? Okay, here we go. Here's the guidance. Let's see. For the first quarter of 2024, AMD expects revenue to be approximately 5.4 billion. Oh, wow. That's below. That's why the stock's down. That's why the stock is down. They did 6.2 billion this quarter. They're saying, hey, we're going to do 600 million less than what we did. That's not growing. At least quarter over quarter, that's not growing. So yeah, that's your AMD argument. There you go. If we had scrolled down, I would have easily seen that one. They expect sequentially, AMD expects data center revenue to be segment to be flat with a seasonal decline in server sales. Oh no. Client, embedded, and gaming segment sales are expected to decline sequentially. Now I know why they put this at the bottom of the fucking PR. If they put that at the top, oh boy. Everything is declining. They said revenue is going to decline. Data center is going to be flat. Server sales are declining. Gaming is going to be declining. Semi-custom revenue expected to decline by a significant double-digit percentage. That's why AMD is down. I mean, it's up now. It's up 1%. So I guess people didn't scroll to the bottom. But that's why AMD is down. Or that's why it was down. Is Google still down? Google is still down 3%. We'll get back into Google in a second. But, oh boy. Sandbagging. They're probably sandbagging. I mean, probably. I would imagine Lisa Su is sandbagging. But still, I mean, if the market's super short term, I don't know if that's like the best thing you want to see right there. All right, so that's what you got on AMD right now. That's what you got on AMD. Okay, so let's get back to Google. AMD guidance shows declines across the board. Okay, so let's go to Google. Let's go to Google and just keep going from there. Nvidia is becoming a monopoly when the chips are down. Why would they teabag that much? Yeah, that's another thing. I understand sandbagging, but like they're saying everything is going to go down, which is a little bit too much. Starbucks missed, yet it's still up. Starbucks missed on a couple of things, but they were very slight from what I looked at. Starbucks, I mean, they grew revenue 11% and memberships 14%. I maybe the street expected a little bit more, but it wasn't enough to get them hit. Okay, let's go back to Google. Let's see what the hell Sundar Pichai is fucking doing here and messing up my money, man. Messing up my money. Just because he's brown doesn't mean I'm down with Sundar Pichai, okay? I need some money. Okay? And if we need to ramp up the ads, then we need to ramp up the ads, Sundar. We got to keep doing it. I mean, you're charging me like $3 extra for YouTube Premium and YouTube TV every month that I'm paying for literally 2 minutes of playing CNBC on the live. It's like, it's not worth it, but I'm paying for that shit. So can we stock to go up a little bit? That's all I'm asking. Okay, so let's get into some better numbers. Let's get into some other stuff. We'll stream the call in about 30 minutes. We'll have the call. Google free cash flow is down quarter over quarter. Okay, let's get into their stuff. Here we go. So how much cash do these guys have on hand? How much cash does Google have? Google ad revenue was lower than expected. Yeah, but it wasn't. I mean, they still. Yes, but they still did well. I mean, they grew ad revenue $6 billion this quarter. So if it's lower, it can't be like multiple hundreds of millions lower, I would imagine. So they have $24 billion in cash. Okay. That's not bad. They have 182,000 employees. So they got rid of 8,000 employees. Revenues, we saw this was, wow, they did 307 billion in revenue. It's just insane, dude. 86 billion for the quarter. Last year, this was 76 billion. So, I mean, year over year, they are growing revenues, right? It's up 12%. Like it's not like this is a declining business. Cost of revenue was 37 billion. That's up only 2 billion. Revenue's up about 10 billion. So that's okay. R&D is up about 2 billion. Sales and marketing is down. No, it's up 600 million. That's not horrible. General administrative, that's barely up. Total costs are up only 4 billion. That's not insane. And then net income, they did 20 billion in profits in Q4. So they did 86 billion in revenue, 20 billion in profits, about a quarter. And Microsoft did about 1/3 of their revenues in net income. For the year, they did 73 billion in profits. Google did, off 307 billion in revenue. Can't explain anything. Efficient market thesis? Yeah, probably. I don't think this is a leadership thing in Google, guys. I mean, a lot of people are saying they don't like Sundar. Google now down 4.15%. Microsoft has, AMD is basically flat or red. Microsoft is down almost 1%. So Microsoft's back to being red. We kind of expected this because we knew it ran up so much. Like we knew these guys ran up so much. But I still thought that, these numbers wouldn't be bad enough for the market to be down 5%. Where's their buybacks, dude? It looked like they bought back $15 billion of stock, but that was me doing math. There wasn't an exact number. Okay, so here's pure revenues. Google Cloud did $9 billion. Other bets did $657 million. Cloud, they made 860. Oh, so Cloud is profitable. Cloud has been profitable for 2 quarters now. That's not bad. So Cloud's not a dying business anymore. That's good. So they made about $1 billion on Cloud and just pure profits. That's not horrible. Where's their guidance? Oh yeah, I didn't even look at Google's guidance. Free cash flow was 7.8 billion this quarter. That might be a little bit lower than the street expected. Okay, here's the guidance. Where's the guidance? The guidance is going to be important. Do they give guidance? Do they do that? 2024. No, they don't give any guidance. Is Google a company that doesn't do guidance? I know like Spotify doesn't do guidance. That's weird, dude. I actually think they don't do. I remember last time. I don't think they give guidance for the year. Yeah, there's no guidance here. There's no guidance. All right. Well, that's Google continuing to get hit by the market. Continuing to get hit by the market down simply for beating on older numbers. The market still has them down. This is sad, dude. This is not what I expected. This is not what I expected. Can someone please explain why we are at all-time highs, but I think it is only because the big seven are carrying the market? Matthew, yeah, you're right. The big seven are carrying the market. That's why these earnings matter. We are at all-time highs. The bears think it's a bubble because big seven don't have the real revenues to produce the growth that the market has conceptualized for us. Two letters are primarily driving the growth, A and I. And that's why these earnings really matter, because if these companies can't put up these numbers, then this whole, thesis that we're in this massive bull market and tech is leading the way, it kind of goes to shit, right? It just doesn't live up to it. Meta's down a little bit on the Google numbers, 396. Palantir is down a little bit. Where's Robinhood? Is Robinhood getting hit? Robinhood's down about almost 0.3% after hours. Snowflake's down a little bit. Enphase is down. Verizon's down. The whole market's down. Apple, wow, look at Apple. They went from 196 to 187 over the past 2 days. They were 191 this morning. Wow. So they fell 2% today. There was a report that came out on Apple, though, that the iPhone 15 is having some supply chain issues. Also, by the way, I don't know if people have been following on social media, but the Vision Pro came out today. Valero, hello. Thank you for being here in the chat. The Vision Pro came out today, like MKBHD, all these big influencers, they got it. And so my thesis has been the Vision Pro and any headset, quite frankly, is a problem that we're looking for a solution. It's a solution looking for a problem, and it's not, people don't really need it. I think if people watch the videos that came out today from the Wall Street Journal and MKBHD, I kind of think that's what it's looking like. It's looking like something that no one's going to freaking use on a day-to-day basis. That's what it's looking like. I mean, the FaceTime of this stuff. Let me show you guys a video. We'll transition to that for a little bit, and then we'll get into Microsoft numbers deeper. It's looking bad, dude. It's not looking like, and I know it's the first generation, but it's just not looking like something that's real. So this is what FaceTime looks like on the Apple Vision Pro. And here's how it is. Azure growth 30%. Yeah, that's one thing saving Microsoft as well. Remember, these companies not dropping is also really good, because that means their valuations are sustained. The street is like, okay, the numbers can prove the valuation, even if they're not going up. But Google dropping to me is ridiculous, because I don't know what numbers are justifying that the valuation is insane. Here's Apple's Vision Pro. FaceTime between 3 influencers.
Now, doing a FaceTime in Vision Pro, I will say, is probably one of the wildest experiences. Oh my gosh. Okay, we were just debating, like, what's your hair stripe going to look like?
It kind of looks blended out, right? It doesn't get the spikiness, but it's there.
Yeah.
Right?
Yeah. The faces are impressive, I think.
Right?
Very, very. It's just at the edge of Uncanny Valley. Like, I know what you guys look like, so I know that they look like you.
This is like I mean, I feel like this is like a 9 out of 10. Like,
okay, so I don't know what they smoked before they got on that FaceTime call, but dude, this is not FaceTime. Like, if I'm FaceTiming my girl, I don't want to see no 3D image of her on the Vision Pro. Like, no, dude, that's not it. Like, I don't know. And so that was one of the big use cases. People were like, oh, you'll be able to put this on and FaceTime. I'm like, you know what you can do to FaceTime? You put this thing in front of you and boom, you FaceTime. Like, I genuinely do not see the use case for the Vision Pro or for any of these headsets outside of gaming, which is not mass market. It's a big market. It's not mass market, or healthcare, which I don't know how comfortable surgeons feel about doing complicated surgery with a headset yet. And then defense, but that's also a very niche marketplace. The average consumer is not walking around wearing this shit. And then, if it gets down to like the sunglasses level, I'm like, first of all, I still don't know why I would put on some random glasses just to like go through my day when I can look at my phone. Second of all, how many years is it going to take to pack all of that hardcore computing, GPUs, batteries, etc., into something that looks like what I'm wearing right now? it's going to take a while. And I'm not going to be subsidizing Apple's R&D by buying these shitty versions at the beginning for that to happen. I'm just so bearish on the Vision Pro, not bearish on Apple stock or that people won't buy it. I'm bearish on the concept of needing a headset. I just don't get it. And today at least kind of showed that the future may not be here. May not be here yet. I'm underestimating adult entertainment. Guys, even that's not enough in my opinion to really sell the Vision Pro. I mean, like, yes, people will buy it for that, but they're just like, that's not billions and billions of devices. I mean, if I'm wrong about that, then we have an issue with humanity, but I don't think that's happening. So Microsoft is down a little bit. Google's still down 3.4%. The market's being dumb, dude, on Google. The market's being really stupid. I'm like, what were the expectations? Hold on. Let me pull up what were the expectations for advertising revenue? Why is it so, like, what did they expect them to bring in like $85 billion this quarter or this year? Like, what did they expect? So here's an article. Let's pull this up. Google Cloud 9.91 versus 8.94 billion. That's a beat. YouTube ads. Okay, that's not even a miss in my opinion. That's a beat. Traffic acquisition costs came in lower than expected. Why is it down? Where's the ad revenue of 65? Oh, so this is why it's down. Ad revenue of 65.52 billion was down from 65.94 billion. Tank the stock, sell it, call every investment fund. We're done. Get rid of it. Are you kidding me? Are you really kidding me? This is insane. This is insanity. This is insanity. I'm tweeting this right now. Here we go. I found out why Google is down 5%. You cannot make this up. There we go. That's insane, dude. That's insane. All right, so that's the reason. Cloud is doing great. YouTube's doing great. Cloud beat. Net income jumped 52%, dude. Oh my goodness. 52. That's not revenue. That's profit. Net income is profit. They did 13 billion last year, 2022. 20.7 billion this year. Come on, bro. That's not that. And there's no ChatGPT's killing search. Like, there's nothing there yet. I mean, maybe in a couple of years, but that's nothing in these numbers. And like, if the street thinks, oh, the 40 million they missed on advertising revenue is because of ChatGPT, and like that's an existential threat to Google, then I'm going to call the streets bluff and I'm going to buy the dip tomorrow if that's really what they're thinking. I'm trying to see what's the reason to not buy this dip. And I don't really see it yet. Not in these numbers. A miss is a miss in this market. Dude, it's 65.5 versus 65.9. That's insane. That's like when I came home. Oh, Google earnings are starting now. Are they starting now? Let me pull it up. That's like when I came home and I got a a 94, and my mom was like, "Why isn't it 100?" Well, I'm not gonna lie to her, she did that once. And I was like, "Mom, it's a 94." She was like, "Yeah, but what happened?" I was like, "I don't know, Mom. I don't know what happened." Oh, they're live. Okay, let's listen to them. They're live. They just started a couple minutes ago. Here we go. Google earnings call starting now.
Searching more accessible and intuitive. Circle to Search lets you search what you see on Android phones with a simple gesture without switching apps. It's available starting this week on Pixel 8 and Pixel 8 Pro and the new Samsung Galaxy S24 series. And Lens now offers generative AI overviews. You can add text to a visual search to ask questions about anything you see and get AI-powered insights in the moment. In addition to search, we are also seeing a lot of interest in our AI-powered solutions for advertisers. That includes our new conversational experience that uses Gemini to accelerate the creation of search campaigns. Then there is Bard, our conversational AI tool that complements search. It's now powered by Gemini Pro and is much more capable at things like understanding, summarizing, reasoning, coding, and planning. It's now in over 40 languages and over 230 countries around the world. Looking ahead, we'll be rolling out an even more advanced version for subscribers powered by Gemini Ultra. That's a good segue to subscriptions. As I said earlier, it's now a $15 billion business annually. YouTube is the key driver of our subscription revenues. Available in over 100 countries and regions, YouTube Music and Premium have real momentum. They're engaging passionate users and driving great returns for the music industry and creators. YouTube TV is also doing well. We've had great consumer feedback on the viewing experience. People love the navigation, multi-view, and unlimited DVR. NFL Sunday Ticket has found its perfect home on YouTube, and Philip will talk about that more. Let me also talk about our subscription service, Google One. It's doing incredibly well with strong user growth. It provides expanded storage, unlocks exclusive features in Google products, and allows us to build a strong relationship with our most engaged users. Google One is growing very well, and we are just about to cross 100 million subscribers. From here, we are going to bring in more AI features and look forward to more strong growth to come. Next, Google Cloud. Throughout 2023, we introduced thousands of product advances, including broad GenAI capabilities across our AI infrastructure, our Vertex AI platform, and our new Duet AI agents. In Q4, our product and GenAI leadership enabled us to win and expand relationships with many leading brands, including Hugging Face, McDonald's, Motorola Mobility, and Verizon. Google Cloud offers our AI hypercomputer, a groundbreaking supercomputing architecture that combines our powerful TPUs and GPUs, AI software, and multi-slice and multi-host technology to provide performance and cost advantages for training and serving models. Customers like Anthropic, Character AI, Essential AI, and Mistral AI are building and serving models on it. For developers building GenAI applications, we offer Vertex AI, a comprehensive enterprise AI platform. It helps customers like Deutsche Telekom and Moody's discover, customize, augment, and deploy over 130 GenAI models, including PaLM, MedPaLM, SecPaLM, and Gemini, as well as popular open source and partner models. Vertex AI has seen strong adoption with the API requests increasing nearly 6x from H1 to H2 last year. Using Vertex AI, Samsung recently announced its Galaxy S24 series smartphone with Gemini and Imagen 2, our advanced text-to-image model. Shutterstock has added Imagen 2 to their AI image generator, enabling users to turn simple text prompts into unique visuals. And Victoria's Secret & Company will look to personalize and improve the customer experience with Gemini, Vertex AI Search, and Conversations. Customers are increasingly choosing Duet AI, our packaged AI agents for Google Workspace and Google Cloud Platform, to boost productivity and improve their operations. Since its launch, thousands of companies and more than 1 million trusted testers have used Duet AI. It'll incorporate Gemini soon. In Workspace, Duet AI is helping employees benefit from improved productivity and creativity at thousands of paying customers around the world, including Singapore Post, Uber, and Woolworths. In Google Cloud Platform, Duet AI assists software developers and cybersecurity analysts. Duet AI for developers is the only GenAI offering to support the complete development and operations lifecycle, fine-tuned with a customer's own code corpus and policies. It's helping Wayfair, GE Appliances, and Commerzbank write better software, faster with AI code completion, code generation, and chat support. With Duet AI in security operations, we are helping cybersecurity teams at Fiserv, Spotify, and Pfizer. Our robust growth has been driven by strong direct and indirect channels. With ISVs, we have nearly tripled the number of co-sell deals from 2022 to 2023. In our ecosystem, there are nearly 90,000 Google Cloud GenAI-enabled consultants, and Accenture has teamed up with Google Cloud to create a joint generative AI center of excellence. Next, let me turn to our focus and discipline as we pursue the opportunities ahead. Search, YouTube, and Cloud are supported by our state-of-the-art compute infrastructure. This infrastructure is also key to realizing our big AI ambitions. It's a major differentiator for us. We continue to invest responsibly in our data centers and compute to support this new wave of growth in AI-powered services for us and for our customers. Through this, we're being disciplined in how we run the company. You've heard me talk about our efforts to durably re-engineer our cost base and to improve our velocity and efficiency. That work continues. Teams are working to focus on key priorities and execute fast, removing layers and simplifying their organizational structures. As just one example, our devices team has brought together different teams from across Nest, Fitbit, and other teams into a new functional structure. This will help us pool resources and drive progress across our Pixel portfolio. Across different teams, we have wound down some non-priority projects, which will help us invest and operate well in our growth areas. We're also improving our machine utilization, building on our years of experience in driving cost efficiencies in our computing infrastructure and operations. And through our supplier efficiency efforts and automation of certain processes, we have made major improvements in areas like procurement, achieving significant savings. That's a snapshot of the quarter. Before I close, a couple of other highlights. Pixel 8, our AI-first phone, was awarded Phone of the Year by numerous outlets. It now uses Gemini Nano with features like Magic Compose for Google Messages and more to come. In our Other Bets portfolio of companies, Waymo, which is deeply focused on safety, reached over 1 million fully autonomous ride-hailing trips. And Isomorphic Labs entered into strategic partnerships with Eli Lilly and Novartis to apply AI to treat diseases, which has great potential. 2023 was a year of profound innovation and product momentum. Thank you to our many partners. We succeed when our partners do, and we are grateful for the work we do together. From our partners across the Android ecosystem who are on display at CES, to our deep relationships with retailers, small businesses, and advertising partners, to the next generation of AI startups and developers, and many more. I also want to thank all of our employees for their hard work throughout 2023 and the start of the new year. I'm excited for what's ahead in 2024. Philip.
Thanks, Sundar, and hi, everyone. Google Services revenues of $76 billion were up 12% year-on-year. In Google Advertising, search and other revenues grew 13% year-on-year, led again by solid growth in the retail vertical. We had particular strength in retail in APAC, a trend that began in the second quarter of 2023 and continued through the end of the year. YouTube ads revenue were up 16% year-on-year, driven by growth in both direct response and brand. And network revenues declined 2% year-on-year. In subscriptions, platforms, and devices, which was previously named Google Other, year-on-year revenues increased 23%, driven by strong growth in subscriptions. Now, for some color on the quarter and where we see continued upside for long-term advertising growth. Over the last few calls, I have consistently highlighted how we're putting Google AI to work for our customers to deliver profitability and help them achieve their goals in a do more with less environment. From a product perspective, in Q4, Performance Max remained a bright spot. We're also excited about demand gen momentum. This is our big bet to help social advertisers find and convert consumers via immersive, relevant visual creatives across YouTube, including YouTube Shorts, Gmail, and Discover.
That's really important when it comes to AI advertising in 2024. That's going to be more important than ever.
In a single campaign, you get access to over 3 billion users as they stream, scroll, connect, and decide what to buy. Tens of thousands of advertisers are testing, and on average seeing 6% more conversions per dollar versus image-only ads and discovery campaigns. As we look ahead, we're also starting to put generative AI in the hands of more and more businesses to help them build better campaigns and even better performing ads. Automatically created assets help advertisers show more relevant search ads by creating tailored headlines and descriptions based on each ad's context. Adoption was up with strong feedback in Q4. In addition to now being available in 8 languages, more advanced Gen AI-powered capabilities are coming to ACA. And then last week's big news was that Gemini will power our new conversational experience in Google Ads. This is open in beta to US and UK advertisers. Early tests show advertisers are building higher quality search campaigns with less effort especially SMBs, who are 42% more likely to publish a campaign with good or excellent ad strength. We can't wait to see how this continues to drive performance and level the playing field for advertisers of all sizes. As we shared last quarter, ads will continue to play an important role in the new search experience and will continue to experiment with new formats native to SGE. SGE is creating new opportunities for us to improve commercial journeys for people by showing relevant ads alongside search results. We've also found that people are finding ads either above or below the AI-powered overview helpful, as they provide useful options for people to take action and connect with businesses. Looking at our strong search performance for the fourth quarter, retail was a highlight. We continue to see a stronger start to the season, up to and including Cyber 5. In Q3, we indicated that we were seeing early trends of consumers being very price conscious, and we saw this play out in Q4. With promotional demand at an all-time high, deal seekers using Google had access to 2 times the deals in the US versus last season, as well as a better shopping experience. Launches included a one-stop shop deals destination, new filters like Get It Fast, and AI-generated gifting recommendations in SGE. These new features drove incremental query growth during key shopping moments like Cyber 5. Our proven AI-powered ad solutions were also a win for retailers looking to accelerate omni growth and capture holiday demand. Quick examples include a large US big box retailer who drove a 60% plus increase in omni ROAS and a 22% plus increase in store traffic using Performance Max during Cyber 5. And a well-known global fashion brand who drove a 15% plus higher omni-channel conversion rate versus regular shopping traffic by showcasing its store pickup offering, pickup later on shopping ads. Moving on to YouTube. We're obviously pleased with YouTube's advertising revenue growth in Q4 and also significant growth in our subscription revenue. I'll reiterate what I have said before. YouTube success starts with creator success. We give millions of creators more ways to create content and connect with fans, and more ways to make money and build their own businesses than any other platform. More creators means more content, which leads to more viewers, and via ads and subscriptions, these viewers fund our creators and drive the eyeballs and engagement our advertisers want. To keep this momentum going, we're focused on delivering value across 4 pillars: creation, viewers, monetization, and responsibility. First, creation, which increasingly takes place on mobile devices. We've invested in a full suite of tools, including our new YouTube Create app for Shorts, to help people make everything from 15-second shorts to 15-minute videos to 15-hour live streams with a production studio in the palm of their hands. GenAI is supercharging these capabilities. Anyone with a phone can swap in a new backdrop, remove background extras, translate their video into dozens of languages, all without a big studio budget. We're excited about our first products in this area, from Dream Screen for AI-generated backgrounds to Aloud for AI-powered dubbing. There's more to come. Number 2, viewers. We continue to grow watch time across YouTube with strong growth in Shorts and connected TV. Shorts remains a top priority. We have 2 billion plus logged in users every month, and we're averaging 70 billion in daily views. Connected TVs, or what we refer to as the living room, is where viewership is growing the fastest. We're investing to make this experience even better with interactive features tailored to TVs, plus the content people love. Our creators, NFL Sunday Ticket, and a range of live sports and studio content via YouTube TV and primetime channels. Put this all together, and YouTube is the must-have app on every connected TV. Monetization is pillar number 3, and realized through a combination of ad-supported and subscription offerings. Advertising generates the bulk of our revenue, and we continue to invest heavily here. We've rolled out CTV-first formats like 30-second non-skippable ads and pause experiences, as well as an industry-first send-to-phone experience that lets people use a second screen to engage with ads. For Shorts, we've developed new formats that are less interruptive to viewers. It's early, we're learning, but excited by the opportunities for ads this can unlock. Shorts monetization continues to progress nicely. Our AI-powered video formats, from video reach and video view campaigns to demand gen and video action, continue to make advertiser dollars go further and drive results across the funnel. We're also introducing new and existing advertisers to YouTube via sports content. 90 plus upfront and scatter advertisers, including Unilever, are partnering with YouTube in our first year across NFL's Sunday Ticket in-game advertising opportunities. Our subscription offerings are also growing at a healthy clip. YouTube Music and Premium performed well. Premium users are delivering more value to our partners and YouTube than even ad-supported users do. On average, each additional Premium sign-up boosts earnings for creators, music and media partners, and YouTube itself. And we've made Premium even more attractive with new features, bundles, and other enhancements. We're also pleased with our first season of NFL Sunday Ticket. It gave creators new opportunities to create content and feed user engagement across traditional user content and professional sports content. Feedback on the user experience, including multi-view, has been great. We're excited to continue to innovate here. Responsibility is our fourth pillar, and it underlines everything we do across YouTube. We'll continue to focus relentlessly on this. As always, deepening our relationships with key partners to bring them the best of Google is a key priority for us, and we continue to do this across industries in Q4. We just talked about the NFL. Sundar mentioned Samsung, among others, earlier. Another highlight was our expanded partnership with Porsche to enhance customers' digital experiences with a deeper in-vehicle integration of Google built-in services, including Google Maps and Play. Whether it's continued collaboration with our partners and key ecosystems, or putting Google AI to work for more customers, I'm excited about the opportunities for continued impact in 2024. I'll wrap with a huge note of gratitude to our customers and partners. Our success is only possible because of their success, and then to our Googlers for their outstanding work and focus this year. Ruth, over to you.
All right, so this is Ruth, the CFO. She's going to now talk about the numbers, and Google's still down about 4%. Tesla's down 2% because the judge in Delaware rejected the $55 billion package. So Tesla and Elon have to come up with a new package 5 years after they came up with the package. Google's down 4.68%.
Thank you, Philip. We are very pleased with our full year results, with 2023 Alphabet revenues of $307 billion, up 9% versus 2022, which added $25 billion to revenues for the year. We ended with a strong fourth quarter, with consolidated revenues of $86.3 billion, up 13% versus last year in both reported and constant currency. Search remained the largest contributor to revenue growth. My comments will be on year-over-year comparisons for the fourth quarter unless I state otherwise. Total cost of revenues was $37.6 billion, up 6%. Other cost of revenues was $23.6 billion, up 5%, with the increase driven primarily by content acquisition costs associated with YouTube's subscription offerings. The growth rate also reflects the offsetting benefit of lapping $1.2 billion in inventory-related charges that we called out in the fourth quarter last year, as well as a reduction in depreciation expense due to changes in estimated useful lives we made starting in the first quarter of 2023. In terms of total expenses, the year-on-year comparisons reflect an additional $1.2 billion in exit charges that we took in the fourth quarter of 2023 in connection with actions to optimize our global office space. As you can see in our earnings release, these charges were allocated across the expense lines in other cost of revenues and OpEx based on associated headcount. Operating expenses were $25 billion, up 11%, primarily reflecting an increase in R&D expenses, which were driven by the real estate charges, followed by compensation. Operating income was $23.7 billion, up 30%, and our operating margin was 27%. Net income was $20.7 billion, and EPS was $1.64. We delivered free cash flow of $7.9 billion, which was affected by the timing of the $10.5 billion tax payment we made on October 16th that we called out previously, related to the deferral of certain tax payments to the fourth quarter. For the full year 2023, free cash flow was $69 billion. We repurchased a total of $62 billion of our Class A and Class C shares in 2023 and ended the year with $111 billion in cash and marketable securities.
Okay, so I was right. They bought back 62 billion. I don't think they broke it up quarter over quarter, but if you just divide it, that's about 15 billion last quarter. So they bought back a crap ton of shares, dude. 60 billion is not a small amount that they bought back.
Turning to segment results, within Google Services, revenues were $76.3 billion, up 12%. Google Search and other advertising revenues of $48 billion in the quarter were up 13%, led again by growth in retail. YouTube advertising revenues of $9.2 billion were up 16%, driven by both direct response and brand advertising. Network advertising revenues of $8.3 billion were down 2%. Subscriptions, platforms, and devices revenues, which we previously referred to as other revenues, were $10.8 billion, up 23%, primarily reflecting growth in YouTube subscription revenues. TAC was $14 billion, up 8%. Google Services operating income was $26.7 billion, up 32%, and the operating margin was 35%. Turning to the Google Cloud segment, revenues were $9.2 billion for the quarter, up 26%. We're very pleased with the momentum of GCP with an increasing contribution from AI. Google Workspace also delivered strong revenue growth, primarily driven by increases in average revenue per seat. Google Cloud delivered operating income of $864 million and an operating margin of 9%. As to our other bets for the full year 2023, revenues were $1.5 billion and the operating loss was $4.1 billion. Results in the fourth quarter benefited from a milestone payment in one of the other bets. Turning to our outlook for the business. With respect to Google Services, first, within advertising, we were pleased with the sequential revenue growth of search and YouTube advertising throughout 2023, which reflects the extraordinary work across our teams to drive improved experiences for users and attractive ROI for advertisers. As we enter 2024 with advertising revenues of more than $100 billion higher than 2019, we remain focused on sustaining healthy growth on this larger base. Second, within subscriptions, platforms, and devices, our total revenues from subscription products reached $15 billion for the full year 2023, driven primarily by substantial growth in subscribers for our YouTube subscription offerings. The substantial increase in our subscription revenues over the past few years demonstrates the ability of our teams to deliver high value-add offerings and provides a strong base on which to build, including through YouTube and newer services like Google One. Play had solid growth again in the fourth quarter, driven primarily by an increase in the number of buyers. In devices, we continue to make sizable investments with increased emphasis on our Pixel family, particularly with AI-powered innovation, while driving further efficiencies across the portfolio. Turning to Google Cloud, we are pleased with operating performance in the year. Full-year revenues of $33 billion were up 26% versus prior year, ending with strong Q4 performance. The cloud team is intensely focused on bringing the benefits of Gemini, our industry-leading AI technology, to enterprises and governments globally, and we are gratified with the level of engagement. The strong demand we are seeing for our vertically integrated AI portfolio is creating new opportunities for Google Cloud across every product area. In terms of profitability, the improvement in 2023 reflects sustained focus across the team with the intent to maintain healthy profitability while we continue to invest to support long-term growth. Turning to margins and expenses, as we have repeatedly stressed, we remain committed to our framework to durably re-engineer our cost base as we invest to support our growth priorities. Key contributors to moderating our expense growth include, first, product and process prioritization to ensure we have the right resources behind our most important opportunities and to reallocate resources where we can. Second, organizational efficiency and structure. We're focused on removing layers to simplify execution and drive velocity. Both product prioritization and the organization design efforts result in a slower pace of hiring, as you can see with our headcount down year on year, reflecting the reductions we announced in the first quarter of 2023 and a much slower pace of hiring. We will continue to invest in top technical and engineering talent. Finally, we continue to execute the other work streams to slow expense growth, including improving efficiency in our technical infrastructure, streamlining operations across Alphabet through the use of AI, increasing efficiency of our spend with suppliers and vendors through our central procurement organization, and optimizing our real estate portfolio. With respect to CapEx, our reported CapEx in the fourth quarter was $11 billion, driven overwhelmingly by investment in our technical infrastructure, with the largest component for servers, followed by data centers. The step up in CapEx in Q4 reflects our outlook for the extraordinary applications of AI to deliver for users, advertisers, developers, cloud enterprise customers, and governments globally, and the long-term growth opportunities that offers. In 2024, we expect investment in CapEx will be notably larger than in 2023. With regard to other bets, we've been working to sharpen our investment focus while capturing the upside, given compelling technology breakthroughs across the portfolio. For example, last week, Alphabet's X announced that it would be moving to spin out more projects as independent companies through external capital, giving X the opportunity to bring more focus to the breakthrough technologies it is working on to address some of the world's most pressing challenges. Thank you. Sundar, Philip, and I will now take your questions.
All right, so Google's down 5.2%, 5.64%. We're going to get into the questions now and see what these analysts are thinking. The stock's down 5.7%, 144. I'm curious what these analysts are going to say. Obviously, these are the guys that are upgrading or downgrading the stock. So let's see why such a negative reaction to this earnings. They missed on advertising by $420 million, but I don't think that's enough to tank it. Microsoft right now is down 1%, and AMD, Starbucks is up 3%. AMD is down about 4%. So AMD is down as well. All right, Q&A.
Thank you. As a reminder, to ask a question, you will need to press *1 on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. And our first question comes from Brian Nowak with Morgan Stanley. Your line is now open.
Great. Thanks for taking my questions. I have two for Philip. Philip, the first one is about sort of a lot of the new generative AI advertising tools. You obviously have a lot of irons in the fire here, even talking about some of the early momentum with tens of thousands of advertisers. The question is, can you sort of walk us through some of the hurdles and gating factors that we should be thinking through that dictate the pace at which these tools can really be rolled out broadly, just so we and advertisers are trying to get an understanding for when they could have a bigger impact on the whole business? And then secondly, how do you think about the long-term sales force intensity of the advertising business as you roll more AI-based tools like PMax impacting the overall ad allocation? Thanks.
Yeah, thank you. Thank you so much. So I've covered this a little bit on previous quarters. AI has been at the core of our advertising products for a very, very long time. And the recent advances are really allowing us to derive more value for advertisers across a large range of different areas, bidding, targeting, creative, as well as our core advertiser and publisher experiences. We are seeing in core search ads, for example, the bidding side, the value-based bidding as a very significant one. On the targeting side, the broad match. On creatives, responsive search ads, automatically created assets. And we're very happy with the progress we're seeing in those areas. I think I mentioned in one of the previous calls that one, you ask about hurdles and gating factors. The AI essentials play a huge role in this, trying to get everybody ready to really take full advantage of those tools. We talked about the progress on PMax as well, that we were very happy with in Q4. So overall, I think we're on track with what we're expecting here. On the sales force intensity side, we have done a few reallocations, or let me call it portfolio adjustments. As you know, we have two large different teams. One is our LCS, a large customer solutions team that's really focused on transformational growth for our largest and most sophisticated customers. And we have our, we call them GCS, Global Customer Solutions team, which is the channel where really every customer starts, from some of our largest customers now to also the millions of smaller ones and SMBs. The GCS is really then scaling growth by dynamically delivering really the right treatment for every customer. And important to note, it's also our fastest growing channel, and it delivered particularly strong growth in Q4. So we have done adjustments here to focus more resources on the GCS side. But I also want to be clear, when we restructure, there's always an opportunity to be more efficient and smarter in how we service and grow our customers. We're not restructuring because AI is taking away roles. That's important here. But we see significant opportunities here with our AI-powered solution to actually deliver incredible ROI at scale. And that's why we're doing some of those adjustments. So I look at Salesforce intensity as a stronger focus going forward on the channels I mentioned here.
Great. Thanks, Philip.
Yo, why did he breathe that heavy, dude? Did he see the stock? Did you guys hear that? I think he saw the stock and he was like, well, that answer just tanked at another 1%. Google's at $141, folks, down to almost 7%.
Our next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking the questions. One for Ruth and one for Philip. Ruth, you're now into year 2 of durably re-engineering the cost structure. Can you just help us assess your progress so far, and are there any guideposts that we should be thinking about going forward? And then Philip, can you talk more about NFL Sunday Ticket and just what your key learnings were in year 1? How are you thinking about the returns on the investment on both, from an advertising perspective, and then also subscribers to both Sunday Ticket and YouTube TV? Thanks.
Thanks for the question. So we are very pleased with the progress we're continuing to make, and we are very committed to the framework to durably re-engineer our cost base, really as we're investing to support the growth priorities. I tried to call out a number of them in opening comments, but really as you're looking at the work being done across Google, across Alphabet, it does start with product and process prioritization to make sure we've got the right resources behind the most important opportunities, and then that creates the opportunity for reallocating resources where we can. Then we talked a lot about this quarter about organizational efficiency and structure, and we're focused on removing layers to simplify execution and drive velocity. The combination of those two, product prioritization and organizational design work, has resulted in the slower pace of hiring. You can see that in our headcount numbers down year on year. You can see it in some of the results that we delivered in the fourth quarter. You can, and it also goes to the announcements around first quarter and much slower pace of hiring. At this point in the quarter, we do estimate that severance-related expense will be roughly $700 million in the first quarter as we've continued these efforts. But as I said in opening comments, we will continue to invest in top engineering. So that's sort of the big one. If you start with product prioritization and organizational design, which is why I also made the note about the severance-related expense, which helps pave the way as we're continuing to do the work that we're doing. But then we have a host of other work streams, which I talked about, everything with improving efficiency in our technical infrastructure, which is a very large ongoing effort, streamlining operations across Alphabet through use of AI, all the work we're doing with our suppliers and vendors, the work we're doing optimizing our real estate portfolio. So when we've described durably re-engineering, it's about continuing to build on work that started, and that is ongoing.
So on the NFL Sunday Ticket side, look, as I said earlier, NFL Sunday Ticket supports our long-term strategy and really helps solidify YouTube's position as a must-have app on everyone's TV set. You ask about some of the learnings. Maybe I start with the viewing experience. We've received great feedback so far. People like the navigation, multi-view, the chat, the lack of latency. Really, really positive feedback on this one. You ask about the ads and the subs. Maybe I start with the subscribers. we're pleased with the NFL Sunday Ticket signups in our first season, both as part of the YouTube TV bundle and as a standalone offering on YouTube primetime channels. Remember, you can access them via both. Nothing more to share on the sub side today on this one. On the ad side, as you know, advertisers can buy from an NFL lineup as part of our YouTube Select portfolio. And this actually allows advertisers to reach football fans across YouTube's pretty unique breadth of NFL content, independently of whether you're doing live NFL games or on YouTube TV or primetime channels or watching NFL highlights or post-game commentary on YouTube channels. And we saw solid demand across the ad market around our YouTube Sunday Ticket offering here. We're excited about the partnership ahead or the partnerships ahead. This is our first season. And I mentioned over 90 upfront and scatter advertisers partnered with YouTube in our first year across NFL Sunday Ticket in-game opportunities, which we really appreciate.
Thank you both.
Our next question comes from Eric Sheridan with Goldman Sachs. Your line is now open.
Thank you for taking the questions, too, if I could. Sundar, a bigger picture question coming back to your comments earlier in the call on search generative experience. When you think about the evolution of product over the next couple of years, how do you envision more traditional search and things like the Google Assistant continue to evolve in a world of search generative experience and Bard, and what that might mean for elements of commercial and non-commercial search and how use cases might change in the years ahead? And then, Ruth, I just wanted to make sure we understood some of the messaging from the release and the public comments around one-timers in the quarter itself. It seems as if they were not allocated to the segments, but are more elements of other bets and Alphabet level activities. I just wanted to confirm where elements of those one-timers were captured in the P&L statement, and whether there were also any elements of legal one-timers that would be called out this quarter as well. Thank you.
Thanks, Eric. Great question. Look, it is an exciting time. Clearly, as I said, as we are incorporating SGE in the product, the early feedback is positive, and we've been iterating on it, and it clearly works for certain type of queries very well. We are expanding the set of queries where it works very well. It definitely is answering a certain category of queries, for the first time in a better way. So that gives us direction to proceed as well. Overall, one of the things I think people underestimate about search is, the breadth of search, the amount of queries we see constantly on a new day, which we haven't seen before. And so the trick here is to deliver that high quality experience across the breadth of what we see in search. And over time, we think Assistant will be very complementary, and we will again use generative AI there, particularly with our most advanced models in Bard, and allows us to, act more like an agent over time, if I were to think about the future, and maybe, go beyond answers and follow through for users even more. So that is directionally what the opportunity set is. Obviously, a lot of execution ahead. But it's an area where I think we have a deep sense of what to do, and all the work we have taken so far, the feedback has been super positive.
And then in terms of your other question, so on the real estate charge, the $1.2 billion in exit charges related to real estate, that is in Alphabet level activities. But the other comment I was making in opening comments is where when you go through the various line items, R&D, et cetera, you see it spread there, and we have a table, and IR can walk anybody through the technicals on that just to understand how it then gets arrayed across the various lines in the P&L.
Our next question comes from Michael Nathanson with MoffettNathanson. Your line is now open.
Thanks. I have two for Philip, I think. Given the importance of connected TV engagement in YouTube, can you talk about the opportunity outside the U.S. for connected TV and what the company is doing at large to drive more adoption of YouTube or connected TVs, given the Google operating system? So anything you talk about outside the U.S.? And then you've been consistent about the strength of Shorts over the past year. You talk a bit about the monetization challenges. Do you still see the headwinds that you saw at the beginning? Anything you could share about the density of the auction or advertising interest on Shorts? So help us with whether or not that's still a headwind to growth. Thanks so much.
Yeah, thank you so much for your question. On the connected TV side, I mentioned it actually continues to perform really well. I said before, YouTube is the leader in US streaming watch time, and it's not just one audience group diving deep. It's really all audiences. On the international side, it's something we are closely looking at. There's nothing specific I have to add at this moment in time on this one. On the shorts monetization side, look, we built shorts to respond to the huge demand from both creators and viewers for short-form video, and we're very pleased with the growth we've seen. I mentioned 2 billion plus logged-in users every month, 70 billion in daily views. Specifically to the monetization question, shorts monetization continues to progress nicely. In fact, actually, since we introduced revenue sharing for shorts, the total creator earnings generated from shorts have increased every month, and we expect this to continue and similar.
No one makes money from shorts unless you're getting billions of views. I've done shorts. They give you like $1 for 30,000. Like shorts are not, there's no money there. So that's a moot point. That's not going to help them.
Obviously, to our long-form videos, we're really committed here to a long-term partnership. And you heard me say this before, right? When creators succeed, we succeed.
Thanks, Philip.
Our next question comes from Stephen Ju with UBS. Please go. Your line is now open.
Okay, thank you so much. So, Philip, this is not a new question, but it's also been about 2 years since PMaps was launched. But it seems like there's been this long lineage of product development and rollout of things like smart bidding in your history, which I believe at the time was designed to help smaller advertisers more easily run search advertising. And today, you're helping me generate creatives as well as manage my spend and maximize ROI across multiple Google surfaces. So, how are you feeling about enabling SMBs who otherwise could not advertise with you before? And what kind of TAM expansion tailwind does that create for your revenue growth over the longer term? Thanks.
Look, as you know, SMBs are a huge focus for us. We mentioned this several times before. They're part of our GCS channel. Not only there's more in this, but they've been under a ton of change over the last few years, and our focus has always been here on investing in solutions that really help level the playing field. And you mentioned several of those. So actually, SMBs can compete with bigger brands and more sophisticated advertisers. And so the feedback we're always getting is they need easy solutions that could drive value quickly, and several of the AI part solutions that you're mentioning are actually making the workflow and the whole on-ramp and the bidded targeting creative and so on. You mentioned it is so much easier for SMBs. So we're very satisfied with what we're seeing here. We will continue to invest, and I feel AI is really a helpful, very interesting future path to make life not only easier, but also much more productive and better ROIs over time, more level playing field for SMBs.
Our next question comes from Justin Post with BAML. Your line is now open.
Great. Maybe one for Sundar and one for Ruth. Just on search growth, I think there are some concerns on use of competitive AI tools as an alternative to search. Just wondering if you've seen any changes in query volumes, positive.
Okay, so this is the GPT question. This is the most important question.
Or negative, since you've seen the year evolve and more search-generated experiences, and what can really make Google stand out versus other AI tools. And then Ruth, CapEx was 11 billion, a step up, obviously. Any one-time items in there, or is that how we should think about the new run rate into 24? Thank you.
Thanks, Justin. First of all, look, we think about effects on search, obviously more broadly. People have a lot of information choices, and so and user expectations are constantly evolving. And so we've been doing this for a long time. And I think what ends up mattering is a strong, continuous track record of innovation. Obviously, generative AI is a new tool in the arsenal, but there's a lot more that goes into search, the breadth, the depth, the diversity across verticals, the ability to follow through, getting actually access to rich, diverse sources of content on the web, and putting it all together in a compelling way. And I think through the year two, when we test search generative experience, particularly against everything that's out there, and we can see the progress we are making and how much users are liking the experience better. And so I think feel very good about the progress, and our roadmap for 24 is strong, both on the search and the underlying AI progress, including the models. So I'm pretty excited about what's ahead of us in 24.
I have consistently said that people saying Sundar needs to be fired are being too mean. That question right there, Alex, you just took the words out of my mouth. I'm with Vitaly in regards to that question right there is why he has to fucking go. And maybe I'm overreacting a little bit right there, but the guy specifically said, is ChatGPT taking your lunch? You're supposed to get up and say, nope, people are still searching, and Bard's getting really good. We're not as good as GPT yet, but we'll get there soon. And Google's going to own the entire generative AI search market, and we think we're making progress. Instead, I don't know what he just said. He said he's excited about the new year. I'm sorry, Sundar. It's not December 31st. That was bad, dude. That was bad. That was bad. That was Google now 5.76% debt. That was the worst. I mean, that's not giving me any help thinking that Bard is going to be better or that ChatGPT is not as big of an issue. That was not a good answer.
And with respect to CapEx, the CapEx of $11 billion in the fourth quarter, as I indicated, was overwhelmingly investment in our technical infrastructure. To your question, there was no one-time item in there. It really reflects is our outlook for everything Sundar and Philip and I have been talking about, the extraordinary applications of AI within Google DeepMind, Google Services, Google Cloud. It's across the board for users, for advertisers, developers, cloud enterprise customers, governments, and it's really the long-term opportunity that offers. So last quarter, we did note that CapEx would continue to grow in 2024. We do expect 2024 full-year CapEx to be notably larger than 2023. As a note, I think you all know this, but timing of cash payments can affect the quarterly CapEx number, but the main point is we're continuing to invest.
Our next question comes from Ross Sandler with Barclays. Your line is now open.
Great, thanks. So I guess question for, I don't know if it's Sundar or Philip, but if we go back to the DOJ trial that happened in the fall, there was a document that was disclosed from Google that said something along the lines of why leaning on ad quality team to deliver 20% RPM growth in search is a fragile strategy. And it was dating back to 2019. Your business has, I think, more than doubled since then. So I guess as we sit here today in early 2024, how do you feel about Google's ability to drive search RPM going forward? And I guess in the context of what Ruth said tonight about the large revenue base, just how do you feel about the monetization? Thank you.
Look, I think I have tremendous confidence in the quality-driven, both our work, be it search quality, ads quality, our improvements on search, our improvements on ads RPM. All two foundational pillars are extraordinary focus on ads quality so that we deliver the actual ROI to advertisers and improve the experience for users, and all underpinned by rigor and technical excellence and go-to-market excellence, right? So the fundamental attributes don't change. I think AI gives us opportunity both on the organic side as well as on the monetization side, and I think we are in the early days of it. I think we'll be able to, taking a long-term view, serve information needs in a deeper way. And, so I think about it with that long-term context, and I'm pretty excited about what's ahead.
And the last question will be from Mark Mahaney with Evercore. Your line is now open.
Okay, thanks. One question on YouTube AI and one on cloud. On cloud first, there's just this volatility, this material deceleration last quarter and then nice reacceleration this quarter. Is that explained by where we are in the optimization cycle and then maybe generative AI workloads starting to trickle in now and cause that growth curve to bend back up? Any commentary just on the sort of the volatility, the deceleration and the reacceleration that we've seen? And then, Philip, I want to ask on the creative side, and particularly on YouTube and ads and the creative, using AI to improve the creative and really to offer SMBs who have been with Google forever, but offer them now performance-based video ad campaigns, created by AI. Is that kind of a new growth area? How far along are you in terms of offering this out into the market? And do you think that this opens up a new, area of spend that wasn't there before? Thank you.
Thanks, Mark. On cloud, let me take that. First of all, combination of factors. I think definitely, excitement around the AI solutions on top of our foundational pillar, be data analytics, infrastructure, security, etc. But AI is definitely something which is driving interest and early adoption. And as you saw that greater than 70% of Gen AI unicorns are using Google Cloud. And so I think it's an area where our strengths will continue to play out as we go through 24, especially when I look at the innovation ahead from us on the AI front. And second, I think, there are regional variations, but, the cost optimizations in many parts are something we have mostly worked through. And I think that was a contributing factor as well.
So on your YouTube question, maybe let me start with a general view. YouTube's mission, has enabled millions of creators around the world to share their voice and connect with audiences and obviously build thriving businesses here. And AI has been a very critical piece of this already. You are obviously aware of the made YouTube announcement where we introduced a whole lot of new complementary creativity features on YouTube, including Dream Screen, for example, and a lot of other really interesting tools and thoughts. You can obviously imagine that we can take this more actively to the advertising world already. As you know, it continues already to power AI, a lot of our video ad solutions and measurement capabilities. It's part of video reach campaigns. Multi-format ads are actually, there's generative creator music that actually makes it easier for creators to design the perfect soundtrack already. And as I said earlier, AI will unlock a new world of creativity. And you can see how this will, if you just look at where models are heading, where multimodal models are heading, where the generation capabilities of those models are heading, you can absolutely see how this will impact and positively impact and simplify the flow for creators, similar to what you see already emerging in some of our core products like ACA on the search side.
Thank you.
Thank you. And that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any further remarks.
Thanks, everyone, for joining us today. We look forward to...
All right. That was the Google call. That guy's last breath was exactly how I think all of us felt, a big-ass sigh from what happened with Google. I'll be on here for the next 10 minutes breaking down what we heard, and then we'll end it off for today. Well, wasn't exciting. And I think we kind of all in the back of our heads knew that the stocks have run up a lot and that we're, due for a little bit more of just some time to relax given how, crazy the market has been. But in terms of the actual call, this was not that good. This was not that good. So a couple of key takeaways in terms of the questions. AI enabling search is very important. And I think in the beginning of the call, they had a lot of good arguments for why AI-based advertising, and particularly the way search advertising will become more personalized and hyper niche for advertisers that have limited budgets. AI is only going to make that better. So everyone is so afraid of advertising going away. And we'll talk about how Sundar answered the GPT question in a second. But AI is only making that better. What is advertising? It's like taking a crap ton of data and then trying to amalgamate that data and meaningfully do pattern recognition to try to get someone's attention. When you have AI doing all that in the background at hyperscale level, at a level that's really understanding the granularity of that data, you just have better results. And that's why Meta has been doing better on their real advertising, Google, etc. The problem is they missed on advertising by $420 million. And that's what really messed it up. By missing by $420 million on their advertising revenue, they beat on cloud, beat on YouTube, all that stuff, or barely, slightly just came in line with YouTube. $420 million of advertising, 65.52 versus 65.94 billion. I think that's what's getting the street like, wait a second, if they're missing, on ads by half a billion, is there a world in which their generative AI tools for advertising aren't really helping yet? Now, 2024 should be a tailwind in regards to election advertising, but and they grew it 12% year over year. I mean, last quarter they did 44 billion. This quarter they did about 48 billion in ads, in search ads in general. YouTube's 9 billion. Last quarter was about 8.3 billion. That's important. That's super important. And so I don't think that's the worst thing in the world. Do we want to do Microsoft? Do we want to stream Microsoft? I was going to end it right now, but do we put in the chat? Do we want to do Microsoft? Because I could stay on and we could do Microsoft and we could listen to these guys. It's up to you guys. Do you want to do it or no? Yes or no? Yes. Okay, we'll do Microsoft then. We'll do Microsoft. Here we go. That's actually really great that it started right after Google. Okay, here we go. Am I in it? Yeah, we're in it. All right, we're doing Microsoft, folks. We're doing Microsoft, and then we'll recap it all at the end. Here we go.
Post our prepared remarks to our website immediately following the call until the complete transcript is available. Today's call is being webcast live and recorded. If you ask a question,
this is actually perfect because I ended it right after Google, so it's actually perfect. All right, so we'll do Microsoft, then we'll recap everything at the end.
You can replay the call and view the transcript on the Microsoft Investor Relations website. During this call, we'll be making forward-looking statements, which are predictions, projections, or other statements about future events. These statements are based on current expectations and assumptions that are subject to risks and uncertainties. Actual results could materially differ because of factors discussed in today's earnings press release, in the comments made during this conference call, and in the risk factors section of our Form 10-K, Forms 10-Q, and other reports and filings with the Securities and Exchange Commission. We do not undertake any duty to update any forward-looking statement. And with that, I'll turn the call over to Satya.
Thank you, Brett. It was a record quarter driven by the continued strength of Microsoft Cloud, which surpassed $33 billion in revenue, up 24%. We have moved from talking about AI to applying AI at scale. By infusing AI across every layer of our tech stack, we are winning new customers and helping drive new benefits and productivity gains. Now I'll highlight examples of our momentum and progress, starting with Azure. Azure again took share this quarter with our AI advantage. Azure offers the top performance for AI training and inference and the most diverse selection of AI accelerators, including the latest from AMD and NVIDIA, as well as our own first-party silicon, Azure Maya. And with Azure AI, we provide access to the best selection of foundation and open source models, including both LLMs and SLMs, all integrated deeply with infrastructure, data, and tools on Azure. We now have 53,000 Azure AI customers. Over 1/3 are new to Azure over the past 12 months. Our new Models as Service offering makes it easy for developers to use LLMs from our partners like Cohere, Meta, and Mistral on Azure without having to manage underlying infrastructure. We have also built the world's most popular SLMs, which offer performance comparable to larger models but are small enough to run on a laptop or mobile device. Anchor, Ashley, AT&T, EY, and Thomson Reuters, for example, are all already exploring how to use our SLM Phi for their applications. And we have great momentum with Azure OpenAI Service. This quarter, we added support for OpenAI's latest models, including GPT-4 Turbo, GPT-4 with Vision, DALL-E 3, as well as fine-tuning. We are seeing increased usage from AI-first startups like Moveworks, Perplexity, Symphony AI, as well as some of the world's largest companies. Over half of the Fortune 500 use Azure OpenAI today, including Ally Financial, Coca-Cola, and Rockwell Automation. For example, at CES this month, Walmart shared how it's using Azure OpenAI Service along with its own proprietary data and models to streamline how more than 50,000 associates work and transform how its millions of customers shop. More broadly, customers continue to choose Azure to simplify and accelerate their cloud migrations. Overall, we are seeing larger and more strategic Azure deals with an increase in the number of billion-dollar-plus Azure commitments. Vodafone, for example, will invest $1.5 billion in cloud and AI services over the next 10 years as it works to transform the digital experience of more than 300 million customers worldwide.
Wow.
Now on to data. We are integrating the power of AI across the entire data stack. Our Microsoft Intelligent Data Platform brings together operational databases, analytics, governance, and AI to help organizations simplify and consolidate their data estates. Cosmos DB is the go-to database to build AI-powered apps at any scale, powering workloads for companies in every industry, from AXA and Kohl's to Mitsubishi and TomTom. KPMG, for example, has used Cosmos DB, including its built-in native vector search capabilities, along with Azure OpenAI Service, to power an AI assistant, which it credits with driving an up to 50% increase in productivity for its consultants. All up, Cosmos DB data transactions increased 42% year over year. And for those organizations who want to go beyond in-database vector search, Azure AI Search offers the best hybrid search solution. OpenAI is using it for retrieval augmented generation as part of ChatGPT. And this quarter, we made Microsoft Fabric generally available, helping customers like Millman and PwC go from data to insights to action, all within the same unified SaaS solution. Data stored in Fabric's multi-cloud data lake, OneLake, increased 46% quarter over quarter. Now on to developers. From GitHub to Visual Studio, we have the most comprehensive and loved developer tools for the era of AI. GitHub revenue accelerated to over 40% year over year, driven by all-up platform growth and adoption of GitHub Copilot, the world's most widely deployed AI developer tool. We now have over 1.3 million paid GitHub Copilot subscribers, up 30% quarter over quarter, and more than 50,000 organizations use GitHub Copilot Business to supercharge the productivity of their developers, from digital natives like Etsy and HelloFresh to leading enterprises like Autodesk, Dell Technologies, and Goldman Sachs. Accenture alone will roll out GitHub Copilot to 50,000 of its developers this year. And we're going further, making Copilot ubiquitous across the entire GitHub platform, and new AI-powered security features, as well as Copilot Enterprise, which tailors Copilot to organizations' code bases and allows developers to converse with it in natural language. We're also the leader in low-code, no-code development, helping everyone create apps, automate workflows, analyze data, and now build custom Copilots. More than 230,000 organizations have already used AI capabilities in Power Platform, up over 80% quarter over quarter. And with Copilot Studio, organizations can tailor Copilot for Microsoft 365 or create their own custom Copilots. It has already been used by over 10,000 organizations, including An Post, Holland America, PG&E. In just weeks, for example, both PayPal and Tata Digital built Copilots to answer common employee queries, increasing productivity and reducing support costs. We're also using this AI moment to redefine our role in business applications. Dynamics 365 once again took share as organizations use our AI-powered apps to transform their marketing, sales, service, finance, and supply chain functions. And we're expanding our TAM by integrating Copilot into third-party systems too. In sales, our Copilot has helped sellers at more than 30,000 organizations, including Lumen Technologies and Schneider Electric, to enrich their customer interactions using data from Dynamics 365 or Salesforce. And with our new Copilot for Service, employees at companies like Northern Trust can resolve client queries faster. It includes out-of-the-box integrations to apps like Salesforce, ServiceNow, and Zendesk. With our industry and cross-industry clouds, we are tailoring our solutions to meet the needs of specific industries. In healthcare, DAX Copilot is being used by more than 100 healthcare systems, including Lifespan, UNC Health, and UPMC, to increase physician productivity and reduce burnout. And our cloud for retail was front and center at NRF, with retailers from Canadian Tire Corporation to Leatherman and Ralph Lauren sharing how they will use our solutions across the shopper journey to to accelerate time to value. Now on to future of work. A growing body of evidence makes clear the role AI will play in transforming work. Our own research as well as external studies show as much as 70% improvement in productivity using generative AI for specific work tasks. And overall, early Copilot for Microsoft 365 users were 29% faster in a series of tasks like searching, writing, and summarizing. 2 months in, we have seen faster adoption than either our E3 or E5 suites as enterprises like Dentsu, Honda, Pfizer all deploy Copilot to their employees. And we are expanding availability to organizations of all sizes. We are also seeing a Copilot ecosystem begin to emerge. ISVs like Atlassian, Mural, and Trello, as well as customers like Air India, Bayer, and Siemens have all built plugins for specific lines of business that extend Copilot's capabilities. When it comes to Teams, we again saw record usage as organizations brought together collaboration, chat, meetings, and calling on one platform. And Teams has also become a new entry point for us. More than 2/3 of our enterprise Teams customers buy phone, rooms, or premium. All this innovation is driving growth across Microsoft 365. We now have more than 400 million paid Office 365 seats, and organizations like BP, Elenco, ING Bank, Mediaset, WTW all chose E5 this quarter to empower their employees with our best-in-class productivity apps, along with advanced security, compliance, voice, and analytics. Now on to Windows. In 2024, AI will become first-class part of every PC. Windows PCs with built-in neural processing units were front and center at CES, unlocking new AI experiences to make what you do on your PC easier and faster, from searching for answers and summarizing emails to optimizing performance and battery efficiency. Copilot in Windows is already available on more than 75 million Windows 10 and Windows 11 PCs, and with our new Copilot key, the first significant change to the Windows keyboard in 30 years, we're providing one-click access. We also continue to transform how Windows is experienced and managed with Azure Virtual Desktop and Windows 365, introducing new features that make it simpler for employees to access and IT teams to secure their cloud PCs. Usage of cloud-delivered Windows increased over 50% year over year. And all up, Windows 11 commercial deployments increased 2x year over year as companies like HPE and Petrobras rolled out operating systems to employees. Now on to security. The recent security attacks, including the nation-state attack on our corporate systems we reported a week and a half ago, have highlighted the urgent need for organizations to move even faster to protect themselves from cyber threats. It's why last fall we announced a set of engineering priorities under our Secure Future initiative, bringing together every part of the company to advance cybersecurity protection across both new products and legacy infrastructure. And it's why we continue to innovate across our security portfolio as well as our operational security posture to help customers adopt a zero-trust security architecture. Our industry-first unified security operations platform brings together our SIEM, Microsoft Sentinel, our XDR, Microsoft Defender, and Copilot for security to help teams manage an increasingly complex security landscape. And with Copilot for security, we are now helping hundreds of early access customers, including CMEX, Dow, LTI Mindtree, McAfee, Nucor Steel, significantly increase their SecOps team's productivity. This quarter, we extended Copilot to Entra, Intune, and Purview. All up, we have over 1 million customers, including more than 700,000 who use 4 or more of our security products, like Arrow Electronics, DXC Technology, Freeport McMoran, Insight Enterprises, JB Hunt, and the Mosaic Company. Now on to LinkedIn. LinkedIn is now helping over 1 billion members learn, sell, and get hired. We continue to see strong global membership growth driven by member signups in key markets like Germany and India. In an ever-changing job market, members are staying competitive through skill building and knowledge sharing. Over the last 12 months, members have added 680 million skills to their profiles, up 80% year over year. Our new AI-powered features are transforming the LinkedIn member experience, everything from how people learn new skills to how they search for jobs and engage with posts. New AI features, including more personalized in-mails, also continue to increase business ROI on the platform, and our hiring business took share for the 6th consecutive quarter. And more broadly, AI is transforming our search and browser experience. We are encouraged by the momentum. Earlier this month, we achieved a new milestone with 5 billion images created and 5 billion chats conducted to date, both doubling quarter over quarter, and both Bing and Edge took share this quarter. We also introduced Copilot as a standalone destination across all browsers and devices, as well as a Copilot app on iOS and Android. And just 2 weeks ago, we introduced Copilot Pro, providing access to the latest models for quick answers and high-quality image creation, and access to Copilot for Microsoft 365 personal and family subscribers. Now on to gaming. This quarter, we set all-time records for monthly active users on Xbox, PC, as well as mobile, where we now have over 200 million monthly active users alone, inclusive of Activision Blizzard King. With our acquisition, we have added hundreds of millions of gamers to our ecosystem as we execute on our ambition to reach more gamers on more platforms. With cloud gaming, we continue to innovate to offer players more ways to experience the games they love, where and when and how they want. Hours streamed increased 44% year over year. Great content is key to our growth, and across our portfolio, I've never been more excited about our lineup of upcoming games. Earlier this month, we shared exciting new first-party titles coming this year to Xbox, PC, and Game Pass, including Indiana Jones. And we've also announced launching significant updates this calendar year to many of our most durable franchises, which brings in millions of players each month, including Call of Duty, Elder Scrolls Online, and Starfield. In closing, we are looking forward to how AI-driven transformation will benefit people and organizations in 2024. With that, I'll hand it over to Amy.
Thank you, Satya, and good afternoon, everyone. This quarter revenue was $62 billion, up 18% and 16% in constant currency. When adjusted for the prior year Q2 charge, operating income increased 25% and 23% in constant currency, and earnings per share was $2.93, which increased 26% and 23% in constant currency. Results exceeded expectation, and we've delivered another quarter of double-digit top and bottom line growth. Strong execution by our sales teams and partners drove share gains again this quarter across many of our businesses, as Satya referenced. In our commercial business, strong demand for our Microsoft Cloud offerings, including AI services, drove better than expected growth in large, long-term Azure contracts. Microsoft 365 suite strength contributed to ARPU expansion for our Office commercial business, while new business growth continued to be moderated for standalone products sold outside the Microsoft 365 suite. Commercial bookings were ahead of expectations and increased 17% and 9% in constant currency on a low expiry base. The strength in long-term Azure contracts mentioned earlier, along with strong execution across our core annuity sales motions, including healthy renewals, drove our results. Commercial remaining performance obligation increased 17% and 16% in constant currency to $222 billion. Roughly 45% will be recognized in revenue in the next 12 months, up 15% year over year. The remaining portion, recognized beyond the next 12 months, increased 19%. And this quarter, our annuity mix was 96%. In our consumer business, the PC and advertising markets were generally in line with our expectations. PC market volumes continued to stabilize at pre-pandemic levels. The gaming console market was a bit smaller. As a reminder, my Q2 commentary includes the net impact of Activision from the date of acquisition, inclusive of purchase accounting, integration, and transaction-related expenses. The net impact includes adjusting for the movement of Activision content from our prior relationship as a third-party partner to first-party. At a company level, Activision contributed approximately 4 points to revenue growth, was a 2-point drag on adjusted operating income growth, and a negative 5-cent impact to earnings per share. This impact includes $1.1 billion from purchase accounting adjustments, integration, and transaction-related costs, such as severance-related charges related to last week's announcement. FX was roughly in line with our expectations on total company revenue, segment-level revenue, COGS, and operating expense growth. Microsoft Cloud revenue was $33.7 billion, ahead of expectations, and grew 24% and 22% in constant currency. Microsoft Cloud gross margin percentage was 72%, relatively unchanged year over year. Excluding the impact of the change in accounting estimate for useful lives, gross margin percentage increased roughly 1 point, driven by improvement in Azure and Office 365, partially offset by the impact of scaling our AI infrastructure to meet growing demand. Company gross margin dollars increased 20% and 18% in constant currency, and gross margin percentage increased year over year to 68%. Excluding the impact of the change in accounting estimate, gross margin percentage increased roughly 2 points, even with the impact of $581 million from purchase accounting adjustments, integration, and transaction-related costs from the Activision acquisition. Growth was driven by improvement in devices as well as the improvement in Azure and Office 365 just mentioned. Operating expenses increased 3% with 11 points from the Activision acquisition, partially impact from the prior year Q2 charge. The Activision impact includes $550 million from purchase accounting adjustments, integration, and transaction-related costs. At a company level, headcount at the end of December was 2% lower than a year ago. Operating margins increased roughly 5 points year over year to 44%. Excluding the impact of the change in accounting estimate, operating margins increased roughly 6 points, driven by the higher gross margin noted earlier, the favorable impact from the prior year Q2 charge, and improved operating leverage through disciplined cost control. Now to our segment results. Revenue from productivity and business processes was $19.2 billion and grew 13% and 12% in constant currency, ahead of expectations, primarily driven by better than expected results in LinkedIn. Office commercial revenue grew 15% and 13% in constant currency. Office 365 commercial revenue increased 17% and 16% in constant currency, in line with expectations, driven by healthy renewal execution and ARPU growth from continued E5 momentum. Paid Office 365 commercial seats grew 9% year over year to over 400 million, with installed base expansion across all customer segments. Seat growth was again driven by our small and medium business and frontline worker offerings, offset by the continued growth trends in new standalone business noted earlier. Office commercial licensing declined 17% and 18% in constant currency, with continued customer shift to cloud offerings. Office consumer revenue increased 5% and 4% in constant currency, with continued momentum in Microsoft 365 subscriptions, which grew 16% to 78.4 million. LinkedIn revenue increased 9% and 8% in constant currency, ahead of expectations, driven by slightly better than expected performance across all businesses. In our talent solutions business, bookings growth was again impacted by weaker hiring environment in key verticals. Dynamics revenue grew 21% and 19% in constant currency, driven by Dynamics 365, which grew 27% and 24% in constant currency, with continued growth across all workloads. Bookings growth was impacted by weaker new business, primarily in Dynamics 365 ERP and CRM workloads. Segment gross margin dollars increased 14% and 12% in constant currency, and gross margin percentage increased slightly year over year. Excluding the impact of the change in accounting estimate, gross margin percentage increased roughly 1 point, primarily driven by improvement in Office 365. Operating expenses decreased 5% and 6% in constant currency, with 5 points of favorable impact from the prior year Q2 charge. Operating income increased 26% and 24% in constant currency. Next, the Intelligent Cloud segment. Revenue was $25.9 billion, increasing 20% and 19% in constant currency, ahead of expectations, with better than expected results across all businesses. Overall, server products and cloud services revenue grew 22% and 20% in constant currency. Azure and other cloud services revenue grew 30% and 28% in constant currency, including 6 points of growth from AI services. Both AI and non-AI Azure services drove our outperformance. In our per-user business, the enterprise mobility and security installed base grew 11% to over 268 million seats, with continued impact from the growth trends in new standalone business noted earlier. In our on-premises server business, revenue increased 3% and 2% in constant currency, ahead of expectations, driven primarily by the better than expected demand related to Windows Server 2012 end of support. Enterprise and partner services revenue increased 1% and was relatively unchanged in constant currency, with better than expected performance across enterprise support services and industry solutions. Segment gross margin dollars increased 20% and 18% in constant currency, and gross margin percentage was relatively unchanged. Excluding the impact of the change in accounting estimate, gross margin percentage increased roughly 1 point, driven by the improvement in Azure, noted earlier, partially offset by the impact of scaling our AI infrastructure to meet growing demand. Operating expenses decreased 8% and 9% in constant currency, with 9 points of favorable impact from the prior year Q2 charge. Operating income grew 40% and 37% in constant currency. Now to more personal computing. Revenue was $16.9 billion, increasing 19% and 18% in constant currency, in line with expectations overall. Growth included 15 points of net impact from the Activision acquisition. Windows OEM revenue increased 11% year over year, ahead of expectations, driven by slightly better performance in higher monetizing consumer markets. Windows commercial products and cloud services revenue increased 9% and 7% in constant currency, below expectations, primarily period revenue recognition from the mix of contracts. Annuity billings growth remains healthy. Devices revenue decreased 9% and 10% in constant currency, ahead of expectations due to stronger execution in the commercial segment. Search and news advertising revenue ex-TAC increased 8% and 7% in constant currency, relatively in line with
Dude, this is stupid at this point. They're just reading numbers. Like, this makes no sense.
Expectations driven by higher search volume, offset by negative impact from a third-party partnership. And in gaming, revenue increased 49% and 48% in constant currency, with 44 points of net impact from the Activision acquisition. Total gaming revenue was in line with expectations. A stronger than expected performance from Activision was offset by the weaker than expected console market noted earlier. Xbox content and services revenue increased 61% and 60% in constant currency, driven by 55 points of net impact from the Activision acquisition. Xbox hardware revenue grew 3% and 1% in constant currency. Segment gross margin dollars increased 34% and 32% in constant currency, with 17 points of net impact from the Activision acquisition. Gross margin percentage increased roughly 6 points year over year, driven by higher devices gross margin and sales mix shift to higher margin businesses. Operating expenses increased 38%, with 48 points of impact from the Activision acquisition, partially offset by 6 points of favorable impact from the prior year Q2 charge. Operating income increased 29% and 26% in constant currency. Now back to total company results. Capital expenditures, including finance leases, were $11.5 billion, lower than expected due to delivery for a third-party capacity contract shifting from Q2 to Q3. Cash paid for PP&E was $9.7 billion. These data center investments support our cloud demand, inclusive of needs to scale our AI infrastructure. Cash flow from operations was $18.9 billion, up 69%, driven by strong cloud billings and collections on a prior year comparable that was impacted by lower operating income. Free cash flow was $9.1 billion, up 86% year over year, reflecting the timing of cash paid for property and equipment. This quarter, other income and expense was in line with expectations at negative $506 million, driven by interest expense and net losses on investments, partially offset by interest income. Our effective tax rate was approximately 18%. And finally, we returned $8.4 billion to shareholders through dividends and share repurchases. Now, moving to our Q3 outlook, which, unless specifically noted otherwise, is on a U.S. dollar basis. First, FX. Based on current rates, we expect FX to increase total revenue and segment-level revenue growth by less than 1 point, and we expect no impact to COGS and operating expense growth. In commercial bookings, strong execution across our core annuity sales motions, including healthy renewals, along with long-term Azure commitments, should drive healthy growth on a growing expiry base. Microsoft Cloud gross margin percentage should decrease roughly 1 point year over year. Excluding the impact from the accounting estimate change, Q3 cloud gross margin percentage will be relatively flat, as improvement in Office 365 and Azure will be offset by sales mix shift to Azure, as well as the impact of scaling our AI infrastructure to meet growing demand. We expect capital expenditures to increase materially on a sequential basis, driven by investments in our cloud and AI infrastructure and the slip of a delivery date from Q2 to Q3 from a third-party provider noted earlier. As a reminder, There can be normal quarterly spend variability in the timing of our cloud infrastructure build-out. Next, to segment guidance. In productivity and business processes, we expect revenue of $19.3 to $19.6 billion, or growth between 10 and 12%. In Office Commercial, revenue growth will again be driven by Office 365, with seat growth across customer segments and ARPU growth through E5. We expect Office 365 revenue growth to be approximately 15% in constant currency. While it's early days for Microsoft 365 Copilot, we're excited by the adoption we've seen to date and continue to expect revenue to grow over time. In our on-premises business, we expect revenue to decline in the low 20s. In Office Consumer, we expect revenue growth in the mid to high single digits, driven by Microsoft 365 subscriptions. For LinkedIn, we expect revenue growth in the mid to high single digits, driven by continued growth across all businesses. And in Dynamics, we expect revenue growth in the mid-teens, driven by Dynamics 365. For Intelligent Cloud, we expect revenue of $26 to $26.3 billion, or growth between 18 and 19%. Revenue will continue to be driven by Azure, which, as a reminder, can have quarterly variability primarily from our per-user business and from in-period revenue recognition, depending on the mix of contracts. In Azure, we expect Q3 revenue growth in constant currency to remain stable to our stronger than expected Q2 result. Growth will be driven by our Azure consumption business, with continued strong contribution from AI. Our per-user business should see benefit from Microsoft 365 suite momentum, though we expect continued moderation in seat growth rates given the size of the installed base. In our on-premises server business, we expect revenue growth in the low to mid-single digits, with continued hybrid demand, including licenses running in multi-cloud environments. And in enterprise and partner services, revenue should decline approximately 10% on a high prior year comparable for enterprise support services. In more personal computing, we expect revenue of $14.7 to $15.1 billion, or growth between 11 and 14%. Windows OEM revenue growth should be relatively flat as PC market unit volumes continue at pre-pandemic levels. In Windows Commercial Products and Cloud Services, customer demand for Microsoft 365 and our advanced security solutions should drive revenue growth in the mid-teens. As a reminder, our quarterly revenue growth can have variability primarily from in-period revenue recognition, depending on the mix of contracts. In devices, revenue should decline in the low double digits as we continue to focus on our higher margin premium products. Search and news advertising ex-TAC revenue growth should be in the mid to high single digits, about 8 points higher than overall search and news advertising revenue, driven by continued volume strength. And in gaming, we expect revenue growth in the low 40s, including approximately 45 points of net impact from the Activision acquisition. We expect Xbox content and services revenue growth in the low to mid 50s, driven by approximately 50 points of net impact from the Activision acquisition. Hardware revenue will decline year over year. Now back to company guidance. We expect COGS between $18.6 to $18.8 billion, including approximately $700 million of amortization of acquired intangible assets from the Activision acquisition. We expect operating expense of $15.8 to $15.9 billion, including approximately $300 million from purchase accounting, integration, and transaction-related costs from the Activision acquisition. Other income and expense should be roughly negative $600 million, as interest income will be more than offset by interest expense and other losses. As a reminder, we are required to recognize gains or losses on our equity investments, which can increase quarterly volatility. We expect our Q3 effective tax rate to be in line with our full year rate, which we now expect to be approximately 18%. Now, some additional thoughts on the full fiscal year. First, FX. Assuming current rates remain stable, we now expect FX to increase Q4 and full year revenue growth by less than 1 point. We continue to expect no meaningful impact to full year COGS or operating expense growth. Second, Activision. For the full year FY24, we expect Activision to be accretive to operating income when excluding purchase accounting, integration, and transaction-related cost. At a total company level, we delivered strong results in H1, and demand for our Microsoft Cloud continues to drive the growth in our outlook for H2. Our commitment to scaling our cloud and AI investment is guided by customer demand and a substantial market opportunity. As we scale these investments, we remain focused on driving efficiencies across every layer of our tech stack and disciplined cost management across every team. Therefore, We expect full-year operating margins to be up 1 to 2 points year over year, even as AI capital investments drive COGS growth. This operating margin expansion excludes the impact from the Activision acquisition and the headwind from the change in useful lives last year. In closing, we are focused on execution so our customers can realize the benefits of AI productivity gains as we invest to lead this AI platform wave. With that, let's go to Q&A, Brett.
Thanks, Amy. We'll now move over to Q&A. Out of respect for others on the call, we request that participants please only ask one question. Joe, can you please repeat your instructions?
Yes. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we pull for questions. And our first question comes from the line of Mark Moerdler with Bernstein Research. Please proceed.
Thank you very much. Congratulations on the strong quarter, and thanks for letting me ask a question. Amy, you've discussed Azure being stable, and you delivered Azure growth stability. But if we drill in one layer, we see Azure AI continuing to become a bigger portion of the revenue. I understand that separating what is directly AI revenue and what is other IaaS PaaS revenue that are leveraging or driven by AI is difficult. Can you help me with two related questions? Optimization has been stabilizing, and at some point, it should be part of the revenue flow. How should we think about what happens then? Do we see non-directly AI consumption being flattish, or do we see a rebound as the cloud shift continues and the need for data inferencing grows? Second part, on AI, where are we in the journey from training driving most of Azure AI usage to inferencing? When do you think we start to the pickup in non-Microsoft inferencing kicking in? When do you think we could hit the point where inferencing is the bigger part of the driver? Thank you.
You want me to go first?
Well, why don't you go first, and I'll take the more technical.
Yeah, let me, just on the inferencing and training, what you're seeing for most part is all inferencing. So none of the large model training stuff is in any of our Azure numbers at all. Small batch training, so somebody's doing fine tuning or what have you, that will be there, but that's sort of a minor part. So most of what you see in the Azure number is broadly inferencing. And Mark, I think it may be helpful to sort of think about like what is a new workload in AI? The new workload in AI, obviously in our case, starts with starts with the frontier model, Azure OpenAI. But it's not just about just one model, right? So you take that model, you do RLHF, you may do some fine tuning, you do retrieval, which means you're sort of either hitting some storage meter or you're hitting some compute meters. And so and by the way, you'll also distill a large model to a small model, and that would be a training perhaps, but that's a small batch training that uses essentially inference infrastructure. So I think that's what's happening. So you could even say these AI workloads themselves will have a life cycle, which is they'll get built and they'll be continuously optimized over time. So that's sort of one side. And I think if I understand your question, what's happening with the traditional optimization, and I think last quarter we said, we are going to continue to have these cycles where people will build new workloads, they will optimize the workloads, and then they'll start new workloads. So I think that that's what we continue to see. But that period of massive, I'll call it optimization only, and no new workload start, that I think has ended at this point. So what you're seeing is much more of that continuous cycles by customers, both whether it comes to AI or whether it comes to the traditional workloads.
Maybe I'll just add just a few things to that. I think whether you use the word lapping, these optimization comparables or the comparables easing, it's all sort of the same thing. That we're getting to that point in H2, that's absolutely true. We'd like to talk about the contribution of AI specifically for the reasons Satya talked about. This is starting to see the application of AI at scale. And we want to be able to show people this is how that's going to look. It's inferencing workloads. where people are expecting productivity gains, other benefits that grow revenue. And so I do think about those as both related, and ultimately the TAM that we go after is best thought of as across both of those, both AI workload and I guess, quote unquote, non-AI workload, although to Satya's point, you need all of it.
Perfect. Thank you very much for the deep answer. Thanks, Mark. Joe, next question, please.
Our next question comes from the line of Brent Thill with Jefferies. Please proceed.
Good afternoon, Amy. The margin improvement is pretty shocking to most, considering the investments that you and Satya are putting in AI. I'm curious if you could just walk through how this is possible and what you're seeing, so far, and some of the costs that you're trying to manage as you scale up AI.
Thanks, Brent. First of all, thanks for the question. The teams are obviously been hard at work on this topic. We do point out that, Q2, because of the impact of the charge a year ago, you're seeing larger margin improvement than I would say is sort of a run rate margin improvement. So let me first say that. Secondly, the absolute margin improvement has also been very good. And it speaks to, I think, one of the things Satya talked about, and I reiterated a bit, which is that we want really to make sure when we're making investments, we're making them in consistency across the tech stack. The tech stack we're building, no matter what team it's on, is inclusive of AI enablement. And so think about it as building that consistency without needing to add a lot of resources to do that. It's been a real pivot of our entire investment infrastructure to be working on this work. And I think that's important because it means you're shifting to an AI first position, not just in the language we use, but in what people are working on day to day. That does obviously create a leverage opportunity. There's also been really good work put in by many teams on improving the gross margin of the products. We talked about it with Office 365. We talked about it in Azure Core. We even talked about it across our devices portfolio, where we've seen materially improvements over the course of the year. And so when you kind of take improvements at the gross margin level, plus this consistency of repivoting a workforce toward the AI first work we're doing, without adding material number of people to the workforce, you end up with that type of leverage. And we still need to be investing. And so the important part, invest toward the thing that's going to shape the next decade and continue to stay focused on being able to deliver your day-to-day commitments. And so it's a great question, and hopefully that helps piece apart a few of the components.
Thanks, Amy.
Thanks, Brent. Joe, next question, please.
Our next question comes from the line of Kash Rangan with Goldman Sachs. Please proceed.
Hi, thank you very much. Superb quarter, great improvements. Just one question for you, Satya. Cloud computing changed the tech stack in ways that we could not imagine 10 years back. The nature of the database layer, the operating system layer, every layer just changed dramatically. How do you foresee generative AI changing the tech stack as we know it? Thank you so much.
Yeah, I think it's going to have a very, very foundational impact. In fact, you could say the core compute architecture itself changes. Everything from power density to the data center design, to what used to be the accelerator now is sort of the main CPU, so to speak, or the main compute unit. And so I think, and the network, the memory architecture, all of it. So the core computer architecture changes. I think every workload changes. And so, so there's a full, take our data layer. The most exciting thing for me in the last year has been to see how our data layer has evolved to be built for AI, right? If you think about Fabric, one of the genius of Fabric is to be able to say, let's separate out storage from the compute layer. In compute, we'll have traditional SQL, we'll have Spark, and by the way, you can have an Azure AI job on top of the same data lake, so to speak, or the lakehouse pattern. And then the business model, you can combine all of those different computes. So that's the type of compute architecture. So it's sort of so that's just one example. The tool stuff is changing. Office. I mean, if you think about if you look at Copilot extensibility with GPTs, Copilot apps to the Copilot stack, that's another sort of part of what's happening to the tech stack. So yeah, I mean, it definitely builds. I mean, I do believe being in the cloud has been very helpful to build AI, but now AI is just redefining what it means to have what the cloud looks like, both at the infrastructure level and the app model.
Terrific. Thank you so much.
Thanks, Kash. Joe, next question, please.
Our next question comes from the line of Karl Keirstead with UBS. Please proceed.
Thank you. I wanted to return to AI. The 6-point AI lift to Azure is just extraordinary, but I wanted to ask you about your progress in standing up the infrastructure to meet that demand. If you feel like Microsoft is supply GPU constrained, if the success you've had maybe working through some of the scaling bottlenecks that some of the other cloud infrastructure providers have talked about, a little bit maybe on the infrastructure scaling front might be interesting. Thank you.
Thanks, Carl. Maybe I'll start, and Satya, feel free to add on. Carl, I think we feel really good about where we have been in terms of adding capacity. You started to see the acceleration in our capital expense starting almost a year ago, and you've seen it scale through that process. And that is going toward, as we talked about, servers and also new data center footprints to be able to meet what we see as this demand and really changing demand as we look forward. And so I do feel like the teams have done a very good job. I feel like primarily, obviously, this is being built by us, but we've also used third-party capacity to help when we could have that help us in terms of meeting customer demand. And I tend to think looking forward, you'll tend to see, and I guided toward it, accelerating capital expense to continue to be able to add capacity in the coming quarters, given what we see in terms of pipeline.
Thanks, Carl. Joe, next question, please.
Our next question comes from the line of Brad Zelnick with Deutsche Bank. Please proceed.
Great. Thank you so much for taking the question. The early market feedback that we're all hearing on Microsoft 365 Copilot is very powerful. Can you provide more granularity on what you're seeing in terms of adoption trends versus perhaps other new product introductions in the past? What, if anything, is holding it back, and how much of a priority is it to get it in the hands of customers? To what lengths might you go to incentivize just getting it out in the market? Thank you.
No, thank you for the question, Brad. And so a couple of things. In my comments, I said, at least in relation to our previous suites, like let's say E3 or E5, whatever, 2 months in, it's definitely much faster than that. And so from that perspective, it's exciting to see, I would say, the demand signal, the deployment signal. I was looking at by tenant, even usage. It's faster than anything else because it's easier, right? I mean, it's sort of, it shows up in your apps. You click on it like any ribbon thing, and it becomes a daily habit. In fact, it reminds me a little bit of sort of the back in the day of PC adoption, right? It's kind of, I think it's first starts off with few people having access. There are many companies that are doing standard issue, right? So just like PCs became standard issue at some point after PCs being adopted by early adopters, I think that's the cycle that at least we expect. In terms of what we're seeing, it's actually interesting to, if you look at the data we have, summarization, right? That's what is like number one. Like I'm doing summarizations of Teams meetings, inside of Teams, during the meeting, after the meeting, Word documents, summarization. I get something in email, I'm summarizing. So summarization has become a big deal. Drafts, right? You're drafting emails, drafting documents. So anytime you want to start something, the blank page thing goes away and you start by prompting and drafting. Chat, to me, the most powerful feature is now you have the most important database in your company, which happens to be the database of your documents and communications, is now queryable by natural language in a powerful way, right? I can go and say, what are all the things Amy said I should be watching out for next quarter, and it'll come out with great detail. And so chat, summarization, draft. Also, by the way, actions. So one of the most used things is, here's a Word document, go create a PowerPoint for me. So those are the stuff that's also beginning. So I feel like these all become, but fundamentally what happens is, if you remember the PC adoption cycle, what it did was work artifact and workflow changed, right? You can imagine what forecasting was before Excel and email and what it was after. So similarly, you'll see work and workflow change as people summarize faster, draft, regulatory submissions faster, chat to get knowledge from your business. And so those are the things that we are seeing as overall patterns.
And maybe just to add 2 points. One of the exciting things, as I said, for some companies, it's going to be standard issue like a PC. For other companies, they may want to do a land with a smaller group, see the productivity gains, and then expand. And so being able to lift some of the seat requirements that we did earlier this month is really going to allow customers to be able to use that approach too. And the other thing I would add, we always talk about in enterprise software, you sell software, then you wait, and then it gets deployed. And then after deployment, you want to see usage. And in particular, what we've seen, and you would expect this in some ways with Copilot, even in the early stages, obviously deployment happens very quickly, but really what we're seeing is engagement grow. As to Satya's point on how you learn and your behavior changes, you see engagement grow with time. And so I think those are just to put a pin in that, because it's an important dynamic when we think about the optimism you hear from us.
Excellent. Thank you so much.
Thanks, Brad. Joe, next question, please.
Our next question comes from the line of Mark Murphy with JP Morgan. Please proceed.
Oh, thank you very much. Is it possible to unpack the 6-point AI services tailwind just to help us understand which elements ramped up by the 3 incremental points? For instance, is it more the OpenAI inferencing, GitHub Copilot, other Copilots, the Azure OpenAI service, third-party LLMs running on Azure? I'm just wondering, where did you see the strongest step up in that activity?
Mark, without getting into tons of line items, it's more simple to think of it as really it's people adopting it for inferencing at the API generally. I mean, that's the easiest way to think about it. And we also saw growth in GitHub Copilot, what Satya talked about, and we saw a growing number of third parties using it, in some smaller ways for training. But this is primarily an inferencing workload right now in terms of what's driving that number.
Yeah,
it's easiest to think of it that way.
Azure OpenAI, and then OpenAI's own APIs on top of Azure would be the sort of the major drivers. But there's a lot of this small batch training that goes on, whether it's RLHF or fine tuning, and then a lot of people who are starting to use models as a service with all the other new models. But it's predominantly Azure OpenAI today.
Thank you.
Thanks, Mark. Joe, next question, please.
Our next question comes from the line of Brad Reback with Stifel. Please proceed.
Great. Thanks very much. Amy, for many, many years in commercial Office 365, seat growth has far outpaced ARPU. And over the last couple of quarters, we're getting a convergence, obviously, as the seat count gets really large. As we look forward, should they run even for a period of time, or should we expect ARPU to outpace seat growth here in the short term? Thanks.
That's a great question, Brad. And let me split apart the components, and then we can come back to whether they should equalize or just go on sort of a bit, actually, believe it or not, somewhat independent trajectories, and I'll explain why I say that. Seat growth, as we talk about, is primarily from, at this point, small, medium-sized businesses and really frontline worker scenarios. And to your point, on occasion, those are lower ARPU seats, but they're also they're new seats. And so you see that in the seat count number. And as we get through, and we've seen that come down a little bit quarter over quarter, and we've guided for that really to happen again next quarter. But a very separate thing is being able to add ARPU. And traditionally, and again this quarter, right, that's come over time from E3, then from E5. And we're continuing to see very healthy suite momentum, and you heard very good renewals. So all of that, right, completely independent in some way from seat growth. Then the next thing that actually we just talked about, maybe in Brad's question, I'm trying to recall, is that you're going to see Copilot revenue will land there as ARPU, right? That won't show as seat growth. So you'll have E3, E5 transitions, Copilot, all show up in ARPU over time, and then you'll have the seat growth be primarily still small business and frontline worker and maybe new industry scenarios. So I tend to not really, Brad, think about them as related lines, believe it or not. I think about them as sort of unique independent motions we run, and there's still room for seat growth, and obviously with the levers we've talked about, there's room for ARPU growth as well.
That's great. Thanks very much.
Thanks, Brad. Joe, we have time for one last question.
Our last question will come from the line of Tyler Radke with Citi. Please proceed.
Thanks for taking the question. Satya, your enthusiasm about GitHub Copilot was noticeable on the conference call and at the AI Summit in New York last week. I'm wondering how you're thinking about pricing. Obviously, this is driving pretty incredible breakthroughs in productivity for developers, but how do you think about your ability to drive ARPU on the GitHub Copilot over time? And just talk us through how you're thinking about the next phase of new releases there.
Yeah, I mean, it's, I always go back to sort of my own conviction that this, generation of AI is going to be different. Started with, the move from 2.5 to 3 of GPT, and then its use inside of the developer scenario with GitHub Copilot. And so, yes, I think this is the place where it's most evolved in terms of its economic benefits or productivity benefits, and you see it. We see it inside of Microsoft. We see it in all the case studies we put out of customers. Everybody had talked. It is the one place where it's becoming standard issue for any developer. It's like, if you take away spell check from Word, I'll be unemployable. And similarly, it'll be like, I think GitHub Copilot becomes core to anybody who is doing software development. The thing that you brought up is a little bit of the continuation to how Amy talked about, right? So you are going to start seeing people think of these tools as productivity enhancers, right? I mean, if I look at it, our ARPUs have been great, but they're pretty low. But frankly, even though we've had a lot of success, it's not like we are a high-priced ARPU company. I think what you're going to start finding is whether it's Sales Copilot or Service Copilot or GitHub Copilot or Security Copilot, they're going to fundamentally, capture some of the value they drive in terms of the productivity of the OpEx, right? So it's like 2 points, 3 points of OpEx leverage would, go to some software spend. I think that's a pretty straightforward value equation. And so that's the first time. I mean, this is not something we've been able to make the case for before, whereas now I think we have that case. Then even the horizontal Copilot is what Amy was talking about, which is at the Office 365 or a Microsoft 365 level. Even there, you can make the same argument. Whatever ARPU we may even had with E5, now you can say incrementally, as a percentage of the OpEx, how much would you pay for a Copilot to give you more time savings, for example? And so yes, I think all up, I do see this as a new vector for us in what I'll call the next phase of knowledge work and frontline work even, and their productivity and how we participate. And I think GitHub Copilot, I never thought of the tools business as fundamentally participating in the operating expenses of a company's spend on, let's say, development activity. And now you're seeing that transition. It's just not tools. It's about productivity of your dev team.
Thanks, Tyler. Thank you. That wraps up the Q&A portion of today's earnings call. Thank you for joining us today, and we look forward to speaking with all of you soon.
Thank you.
Thank you.
All right. We are done with two of the most important companies, not only in the world, but definitely in this market cycle, Google and Microsoft with their earnings. We've got Meta, Amazon, and Apple. Later this week, I'll be streaming it all on this channel. So if you are not subscribed, please make sure to subscribe and like the video. All right. So let's do a little 10-minute breakdown of everything that I heard. TLDR, Google sucked. Microsoft did great. That is like the quick rundown on these calls. And then we'll go a little bit more deeper into it. Let's do Microsoft right now since we just heard from them. First, let's look at the stocks and how the stocks are doing because these stocks have gone through a lot of emotions today. So Microsoft is down about 1%, which is not that crazy. It went all the way up to 413, came down to 397, now back at 404. We'll see what the market takes it tomorrow, but it was down a little bit more aggressive before the earnings call. And then once Satya Nadella started spitting that hot AI fire. By the way, I'm going to go to the transcripts tonight and see how many times Google and Microsoft said AI. I'll tweet that out tomorrow. I'll let you guys know when the market open. That's when the stock started rebounding, and now the stocks is barely down 1%. It was actually 410 just like 10 minutes ago. So that's what we got on Microsoft. And then Google is down 5.63% at 144. At this point, I would like Google to fall like a legitimate 10%, get us down to 135, and that's when I'll buy more because at 145, to me, it's not interesting buying the dip, but if it gets lower than that, then it would be more interesting as well. So that's what we got on Google. Now, why is there a disparity between Google stock price and Microsoft stock price? Well, let's talk about Microsoft first. I think they crushed the earnings call. I think in general, analysts didn't get anything new that they didn't know about the OpenAI partnership or GPT-4 or the ability to implement and operationalize all the stuff they're doing with AI. Copilot. I have to go deeper into the numbers. I didn't see any high level, like granular numbers on how many people are buying Copilot. Maybe I just missed that. If anyone has that, let me know in the chat. But I've got to look into it tonight because that is what they're touting as AI. So far, they're coming up with this keyboard, and their argument is that we're going to have a Copilot button on the keyboard that hasn't changed in decades, and that's going to interact, or that's going to change how users interact with Windows in general. And so they are really betting their bets on Copilot. The street's thinking 10% of the 400 million people that use Microsoft Office will pay $30 a month for Copilot. That'll be about $16 billion in top line revenue. And that's why they're giving them a 5-6x multiple on that from a market cap perspective. 16 times 5, you get to 80 billion, 100 billion bucks of just, more valuation multiple expansion because of that Copilot revenue. Now, that's one element of the pie. And they talked about that. Wasn't that crazy? But what they talked about in cloud to me was very exciting. What they talked about on cloud was basically Nadella saying, look, this is a game of who can actually help startups and enterprises understand what they're doing with AI, how they're doing it with AI, and then help them get the infrastructure to implement large-scale AI solutions. Unlike a Palantir that is trying to literally help be the operating system of your entire company, Microsoft doesn't give a shit. They really don't give a shit. Microsoft cares about if you're using whatever Palantir is selling you or Snowflake selling you or Datadog is selling you on Azure's AI cloud. And that is growing 20% year over year. Google is growing 25% year over year, but Google's only bringing $9 billion of revenue from cloud. Microsoft's bringing about $25 billion of revenue from the cloud. And I think that stat right there sums up Google and Microsoft. The street wants AI. The street wants cloud. Microsoft's growing less than Google and cloud, but they're growing at almost $11 billion more than what Google's putting up per quarter right now. And as a result of that, Microsoft Cloud is just unprecedented. Google's strategic mistake 10 years ago, not 10, let's say 5 years ago. There's two. Number one, not being the first to market with their version of ChatGPT, even though they had the technology to do it with DeepMind. Very big mistake. And I think we'll see what happens. But it's one of those mistakes that might end up either costing Sundar his job or leading to the company really struggling over the next 10 years if Microsoft, gets away with it. Not because ChatGPT is eating their lunch, but because if they had come out with OpenAI's ChatGPT before and they called it, something cooler than Bard 5 years ago, they would have a lot more experience in what it takes to run large-scale AI applications at scale. And I think they would have come up with AI cloud in a much more quicker and efficient way and realized, wait a second, we can sell this shit to the market way more than a $20 per month subscription to ChatGPT or Bard. Like OpenAI's GPT is just a way for consumers to interact with it, but the real money's in the enterprise. That's why Palantir is going after it. So at the end of the day, whatever software Palantir is selling, Microsoft's making a ton of money on the back end because of Azure Cloud. Google's not making that much money off cloud yet, even though it is two quarters of profitability. They brought in $864 million of profit, but it's not as much as Azure. So my concluding thoughts on Microsoft is that Azure's the golden child. It's winning. It's not stopping. It's going to keep growing. Will it keep growing 15% year over year? I don't know, but it's going to keep going up. And if you want AI, exposure, and you're a conservative investor, Google down now 5.59%, and you have $6 trillion on the sideline in money markets when you come back to play with Mr. Market, and Microsoft's maybe at 380 versus 400 or 350, and you need to get some exposure, Microsoft might be the first company you look to. So from that perspective, I think Microsoft is going to get a ton of benefits from their cloud growth, and that's what this earnings call basically proved that they were going to be able to do. Now, in the context of Google, the two biggest mistakes they didn't do 5 years ago: release a real version of ChatGPT and focus on AI cloud. And they're paying for that right now because the search business, they did $85 billion in revenue. The search business seems to be basically 90% of the revenue. So it's at some level, you got to ask yourself, like, where's the diversification? And I think investors are like, well, if you're not even meeting your numbers on search, which they missed by 420 million, it's such a it's 0.6%, so insignificant in the broader scheme of things when they bring in 65.52 billion, but it's something that gets the market upset. And so that's why the market's upset right now in the context of Google. Now, in terms of the actual call, I think the call was a disaster. I don't think they answered any questions in a meaningful way. They just, they had one good segment where they were talking about AI based advertising, which is actually very good. The problem is you missed on your advertising number. You didn't really have a reason for why you missed on your advertising number. You didn't give any real guidance for what 2024 is going to be like. And the one time you get a question to just shit on ChatGPT, and the guy's like, hey, he didn't even call out GPT. He gave him a layup. He's like, so there's other things out there that are taking away attention from search. What do you think? And Sundar's like, well, I'm really excited for 2024 and our progress in AI. It's like, no, dude, you can't do that. You cannot do that. If I was Sundar, it's a very simple answer. I mean, I don't know why these guys are so scared sometimes to talk. I'd be like, well, look, the elephant in the room is that ChatGPT is a bit more powerful than Bard right now because GPT is a bit more advanced than Gemini. We understand that. The market has given us that feedback. However, in terms of our results, we have seen that GPT-4 and LLMs have taken basically zero market share from Google search because at the end of the day, we believe our product is better. We've introduced generative AI and LLMs as a form of compute, not just as a form of chat, in order to make search better. And people still want to click on things in order to get the right results. And we have seen no meaningful changes from ChatGPT in interrupting our business. And you can also see it in the numbers. On top of that, we believe Gemini, which is powering Bard, is going to get better and better and better. And because we have the most sophisticated levels of researchers on the planet and enough money to subsidize this, we believe Bard will also become as strong as GPT. So right now, we don't see any significant market share being taken away. We think a lot of people want to search. And we think in the world of LLMs, generative AI search on Google.com, the thing that 88 billion times a month people go to, is just going to get better and better and better. So I'm excited for the future, but I really think we have a phenomenal product. That's it. Simple. Nothing too crazy. Just take honesty is the best policy. When I did debate in high school, there was a term called strategic concessions. A strategic concession is when you are debating and someone says something and they're right. It's way better to just concede the argument versus try to cover up for the fact. And I'm going to play that tomorrow on the Market Open. But the way he sounded when they asked him about GPT, this was the question that you prepared all 90 days for. This is the question I want to know as a shareholder. You guys have got it under control. And even if things aren't amazing, it's obvious Gemini's not as good as GPT. I just want you to be honest about that. And then I, as a shareholder, can decide if I want to give you guys the capital and the time to subsidize your R&D to be able to work against GPT. And ironically, if you're just honest, it makes it way easier for me to be like, yeah, these guys are going to work on it. They have all the resources and I'm willing to take that bet. That's the nature of being transparent with investors and them getting to care about, your progress. And so if he was just honest and he had a strategic concession where he was like, yeah, look, we know GPT-4 is probably a little bit better than Gemini right now. We've received that feedback, but we are rapidly accelerating. We have not lost a single thing from our search business. I mean, if I was Sundar, I would have been like, people thought search was dead. Does $65.52 billion sound like death? Not to me. It sounds like a Lambo times a trillion. Like, it sounds like we are not dead. It sounds like people want to use our product, and we're just going to make our product better and better and better. And I would have asked the analysts, hey, have you used generative AI search? Because when you type stuff in, we don't just give you links anymore. We give you a summary of stuff, and then we give you links. So we give you a dual-sided option. And by the way, if you use ChatGPT and Bing, that thing takes forever searching with Bing, and then it gives you a shitty result because Bing sucks. I would have literally just been like, Bing sucks. We know that Bing sucks. Bing gets 1 billion users of visits a month. Google gets 88 billion. Obviously, the market, which is the entire planet, has said at 88 times, we like Google. We prefer Google over Bing. And then if you use any type of GPT-4 real-time search, you get the worst results because Bing sucks as a platform, and then they haven't really incorporated well with GPT-4. So I would have been honest about that. And he was not honest at all. He shied away from the question. And that's why, maybe Sundar needs to really reevaluate how he either answers questions, or Google has to figure out if they need someone else running the ship. I mean, Satya Nadella, Microsoft was stuck for 10 years before Nadella. It was in a very tough situation under Ballmer. Ballmer made a lot of money, but shareholders did not make a lot of money. It was in a bad spot. And then Nadella came and he right-sized the ship, and he really made sure that things were going to go in the right direction. And I think on this earnings call, the way he talked, even his enthusiasm in the beginning of the call about where, the world is going, that was exciting. If you're Google CEO, you can't be as excited as Microsoft CEO because Satya Nadella has OpenAI and he has cloud growth out the wazoo. Maybe even better than AWS. We'll see in a couple of days. So of course he's going to be more excited. But you have to manufacture your excitement. I know it's hard to be excited about search ads, but dude, if I'm the CEO of a company that just brought in $86 billion of revenue, I'm going to sound a little bit more excited. I'm going to sound a little bit cooler. And just, there's some days where I wake up a little groggy, and for the market open, I'm not the most excited as what I usually am. But as soon as you put on that camera, as soon as you press record, as soon as you go live, you realize you have the opportunity to talk to people that actually care about your thoughts and opinions, and entertain them and give some insight into their day. And so if I'm the CEO of Google, there's millions of people hearing me right now. Can I act a little bit more excited about the fact that $86 billion of value is generated because of a fucking website where you type in things and they show blue links? Like, how much better of a job could you ask for? But no, he sounds boring. He sounds unenthusiastic. He's barely answering questions. It was a train wreck, in my opinion. It was absolutely a train wreck. And I think the market agrees with me because the stock's now down 5.54%, and it has not recovered. Joshua says, I disagree that ChatGPT with Bing gives you bad results. So in my experience, when I ask ChatGPT a real-time question, something that I need real-time results for, it searches with Bing. It takes far longer than Bard, and then it spits out some nonsense. It really does. And maybe it's just the things I'm looking up. I don't know. But in my experience, Bard, I've used Bard on the market open stream like many, many times. It's been phenomenal, like absolutely incredible. Just because generative AI search on Google without Bard is also really good. That like summary that pops up at the beginning before you get to the links, it's getting really good. If I was Sundar, I would be like, guys, I would be like, they wanted us to come dance at the prom. They're not even in the running for prom king or queen. Like, that's how I would have started my fucking answer to that question. Okay. And that's what I would have said. And I think a lot of analysts would have got excited. They would have been like, damn, this Sundar guy's a killer. Like, if you're a CEO, you got to be a effing killer. And he did not sound like a killer. He just didn't. Nadella's animated like Jensen, not Sundar. Yeah, I agree. Jensen Huang is a killer. Nadella is a killer. They're excited. They know where the world is going. And maybe the world's not going towards, advertising, but that's where you make your money, and you have to get people to sound you have to get people to feel excited, even if you're not excited. That is what a leader does. You get your employees to feel that the mission is worthwhile, even if, you may not necessarily agree with it. That's the nature of being a leader. And I just didn't feel like he really led in that call. All right. That's it for me. Thank you, everybody, for joining. This was my earnings presentation and breakdown. I think Microsoft did great. Google did not do good. In general, thoughts on the stock. I am not selling any of my Google options that I have. I have them expiring in 2026. So I think we'll be fine. Google should hopefully get to $200 by that time. I don't think that's going to be a big deal. They bought back $15 billion of stock. I think they'll be okay. 144 right now. Let's see where the market takes us tomorrow. I kind of think the dip is going to get bought tomorrow because I think this is an overreaction. I think it's a very obvious overreaction, even though the earnings call was bad. But I think the dip gets bought. Microsoft, I don't know if the dip gets bought, but I don't know if they inch that much higher. I mean, it's kind of just, it's at a good valuation. I would imagine that it stays flat or stays there. SoFi down about 1.55% after hours, 827. Palantir 1657. S&P is slightly red after hours, down 0.38%. And then the Qs are also slightly red, down 0.76% after hours as well. So not too bad. S&P at 489 after hours. Oh, this, yeah. I mean, look, we'll talk about it tomorrow on the market open, but let me just show you guys Tesla. I forgot. There was so much news coming on today. Elon Musk has lost the shareholder package this is so weird, dude. Tesla's down 4%, 184 after hours. Elon lost the shareholder package that he won in 2018, which is approximately $55 billion. And he's not happy about that at all. So this is what he tweeted just now. He said, never file your company in Delaware, which is, so he's mad about that. A Delaware judge rejected the package. And then this is what happened. The Elon Musk $55 billion pay package at Tesla was struck down by a Delaware judge after a shareholder challenged it as excessive. I don't understand how Elon Musk, one of the most hardest working people in the world, was deemed as excessive. I mean, like, this guy works harder than everybody. And you deserve to be, like, at what country are we building where you don't deserve to be rewarded for something like that? The decision means that more than 5 years after the electric car maker's co-founder was granted the largest executive compensation plan in history, Tesla's board will have to start over and come up with a new proposal. The weird thing about this was, in order for him to get this money, he had to reach certain milestones in regards to the market cap. He did all of that. Like, Tesla 20x'd in 2019. Like, he did it. And now they're saying it's too much. So that really sucks. The major implications here for the company is that they're going to have to waste time coming up with a new package. The bull case is that now his 25% voting thing, maybe this gets negotiated and maybe he makes less money, but he gets more control, which is probably what he cares about. So technically this could be a good thing for Tesla shareholders long-term. But in terms of the stock, it's not the best. And in terms of the actual folks on the company, it's also not the best right now. So that's what we're seeing from Elon and Tesla. Do you think Elon will leave Tesla? No, he's not leaving Tesla, but he's definitely going to have to rework his entire package and compensation structure now. All right, that's it for me. Thank you, everybody, for joining. We had a 3-hour stream. This was epic. I don't think we have any crazy earnings tomorrow. I could be wrong. I think maybe Meta's tomorrow, but we have Apple and Amazon on Thursday. So we'll do Apple. Yeah, I think Meta's tomorrow, so that'll be the big one. And then Apple, Amazon Thursday. If I'm wrong about that, then we'll see what other earnings we have tomorrow. I'll see you guys on Finance Junkies, 9 p.m. We'll recap these earnings, and I will see you 8:45 a.m. tomorrow on the market open. Thank you, everybody. Have a great night. I'll see you later. Bye-bye.